Sorry, I'm slightly late, so we should probably start now. Okay, well, welcome. As you can see, my name is Sebastian Campbell. I'm going to be lecturing you on productivity and venture capital. I don't really like the word lecture. I really want you to participate in this class. That will explain why you probably saw that 10% of your grade is going to be about participation. So let me explain what it is. If you were studying in the US, and at Harvard, it would be 50% of your grade, participation. At Wharton, where I studied, it was 30%. In the UK, for some reason, participation is not appreciated. I'm not quite sure why. I think it's a mistake, because you're not going to learn anything if you don't participate. I guarantee you. You will listen to somebody talking to you about whatever he thinks he knows. You won't really engage. If you're not engaged, you're not going to learn much. So participation, I think in my view, is vital. 10% is the maximum the school allowed me to put in. I would have asked for 30%, but they refused. So let me explain what participation is. There'll be two aspects to participation grade. The first one is about you participation in class. There will be 3 case studies. I've added 1 this year, last year there were 2, hopefully next year there'll be 4. In my view, every single class should be case study. That's what it is at Harvard, as you probably know. It's a case study school, so they only teach case studies. There's no lecture. Instead, what I will do is I will have 3 lectures on productivity, 1 case study, 3 lectures on venture capital, 2 case studies on venture capital. My background is in both productivity and venture capital. I worked for 4 different fund managers, 3 in productivity, 1 in venture capital. So I used to work for fund managers, and I worked for family offices and high net worth individuals, people who invest their own money directly into companies. So they don't want to work through a fund because they realize that they lose money on fees. So instead they want to invest directly in the company. So that's what I allow them to do. I do due diligence for them, or explain to you what due diligence is about. And after that, they decide what they want to do with their money, whether they want to invest or not. The second aspect of participation is going to be attendance to guest presentations. The school asked me as part of the course to bring in some of my contacts. Okay? I was a fund manager, so obviously over many years I came across lots of people. Some of my former colleagues will come to present to you. Other people I've known for 15 years will come to present to you. All of them are very senior. They're all partner managing directors in companies, and they come to campus for you. Not for me, because I can see them for lunch whenever I want to. They come here to talk to you. So if they come to talk to you, that means you have to attend, right? There's no point in me bringing people who have 40 years of experience, some of them 30 years of experience in the industry, if you're not going to bother showing up. So 3 years ago, when I started coming here, I brought some very senior people. They showed up on campus, and students decided not to turn up. So I had one guy coming from Axel Partners, one of the biggest funds in venture capital in this country, and 20 students showed up. So that's pretty embarrassing for me. It's embarrassing for him. It's actually quite insulting. He told me that. He felt insulted. You should realize that when you apply for jobs, you are in competition. You're in competition with the LSE, with LBS, with UCL. So if these schools bring in speakers and the students actually attend and you don't, what do you think it does to the school? Give a bad reputation to the college. When your CV shows up on the desk of these people, they say, oh yeah, I know these people. I went to a presentation 2 years ago, they didn't turn up. So for that reason, I made participation compulsory. Now I can't make it compulsory for all the guest presentations. There will be 7 guest speakers. You will have to attend at least 2 of these. So a list will be put together by the admin team, and every student will have to attend at least 2. That means you have to sign up, proving that you are attending. I know it's pretty sad. I hope I didn't have to do that, but unfortunately, because of what happened 3 years ago, you're paying for it. So you have to attend at least 2 of them. My view is that you should attend all of them. Again, these people come here to talk to you, not talk to me, or because they have a pleasure being in South Kensington. They come here to tell you about their job, about what they do for a living. And it's part of, again, because it's in participation, it's part of really you getting a better understanding of what private equity and venture capital are all about. I think, I totally understand why the school asked me to bring in these guest speakers, because it's better for you to get a sense of not only what I teach you in the lectures, but also what you can gather from people who actually work on the ground. There are some seats here if you want. So that's really where the 10% comes from. So it's going to be new participation in case studies and attending guest presentations. And again, ideally, I realize the school has a video link, so you obviously all these lectures are recorded, so I understand sometimes you can't attend, and therefore I'm happy for you to watch the videos, but in my opinion, you really will get a lot more if you attend and if you participate in class. The case studies will be team-based, and so will the coursework assignments. Only the final exam is individual. What that means is that you will set up your own teams. So for the case studies and for the coursework assignments, you set up your own teams. The teams have to be 5 to 6 people. Not 4, not 7 or 8, 5 to 6. You have to determine, obviously, who you're prepared to work with, but even if you're not prepared to work with them, that would be a good training for when you go to work. Because believe me, there'll be a lot of colleagues you don't want to work with, but you'll have to. So if you can't come up with 5 or 6 people to work with, the admin team will obviously organize it for you. But I think what you have to do is by this Friday or by some point next week, you have to set up your own teams for these. So there'll be 2 teams. There'll be there'll be only 1 team for case studies and for the coursework assignments, and there'll be obviously you attending the guest presentations. That would be the admin team putting it together. Okay? Hopefully it will make sense when we talk about it. So on top of the 10% participation, there'll be 30% on coursework. Coursework, you have 2 of them. Coursework 1 obviously would be 15%, it'll be on PE, that would be an LBO model. And coursework 2 will be on VC, obviously 15% as well. And that will be what we call a liquidation table, and I will explain to you obviously during the course what it is. And finally, at the end, you have the final exam. And the final exam would be a bit of MCQ. Yeah, you can sit here if it's easier. I promise you I'm not dangerous. If you don't want to stack up at the end, feel free to come to the front. Okay. I have a feeling that this room is not going to be big enough. I'm not sure why they booked this one, but if I understand correctly, we have 260 students, so I'm not sure how we're going to put all these people in this room, but anyway. So the final exam would be 40% MCQs, 10% open-ended questions, and 50% case questions. So the case would be, I'll explain to you a product case study, a VC case study, and then you will have to answer questions on that case study. Are there any questions? No questions? I mentioned to you the best way to learn is not just to listen to a lecturer, even though I hate the word, this is what they call me. The best thing is to participate. There's another aspect which I'd like you to get involved in if you're interested. 2 years ago, some students came to me and they said, well, I'd like to be involved, especially on the VC front, on proper startups or projects. And then I thought, well, there are 15,000 students, engineering students. Many of them are entrepreneurs. They have their own projects. They've got the technical skills, and they develop their own products. You also have what we call the Create Lab here, which is obviously some kind of incubator. They have what they call the Hackspace. So you have lots of things on campus, but the students were struggling to meet these people. So I've come up with what I call cross-campus projects. They are not part of your grade, but in my view, if you are serious about getting into the VC space, these projects are all on early stage. I think it looks great on the CV if you have been involved on a project. So these projects are engineers on the other side of the campus who work on their own startups, their own projects, and they are looking for financial skills. Most of these engineers are very technical, very good at understanding products, technology, but they know absolutely nothing about finance. And this is where you come in. So if you want to be involved, what I will do is I will post one-pagers on each of these projects. I'll put them on the hub in a folder called Cross Campus Projects, and you apply directly. It's like applying for an internship, or a job, whatever. You apply and you deal with it. I don't get involved, unless obviously you have questions about how to help with startups or these projects. But it's really for you, if you are interested in getting involved in projects, to actually apply to. Okay, so these people are engineers, many of them PhDs. Some from the Hackspace are already graduates, so they don't know if you know how it works, but the alumni have access to a Hackspace, an area where they can launch their startups, develop their own projects, all paid by the school, so they give them access to a location, just not on campus, so it's very nearby. And these people basically can develop whatever they want to do with the company they have in mind. And obviously these people would like to involve people like you, because they don't have the financial skills. Okay? So that's the other thing. And in my view, if you attend lectures, if you participate, if you attend the guest presentations, and if you get involved in a project like this, you will have a much better understanding of this class. This class is not about theory. You won't do theory. You probably did your corporate finance, accounting classes. I'm very happy for you to have the basics. That's really what it's for. I don't teach CAPM because I think it's rubbish. I don't teach accounting because I think it's very important, but somebody else should do it. But I teach practice. I'm teaching you what I do at work. So a lot of it obviously will be the theory. I need to teach you a lot of jargon, and I apologize in advance. There's a lot of it, but unfortunately, private equity and VC fund managers feel self-important and need to create new words every now and then. So there's a lot of words you've never seen before. I have to teach you these words. But we go beyond that, and we go into the practice, how deals are done, how portfolio companies are managed, how funds are raised, how they're sold. So there are very few formulas. There are a few ratios, obviously, in my class, but don't worry, there won't be any technical math there. You need to have, you need to be comfortable with numbers. We do an LBO model. We don't have time, unfortunately, in 4 weeks of PE class. In my view, the whole class should be PE and the whole class should be VC. There should be 9 weeks of private equity, 9 weeks of VC, but the school doesn't want to do that. So I'm teaching you all this in a very, very combined space at a time. So unfortunately, we go very quickly, but there will be an LBO model. There will be what we call cap table and liquidation table in the VC block. And this is really what you need to understand if you want to work in that space. Any questions before I start? No? I suspect you have some on the teams and everything, but just to remind you, you need to set up your own team for coursework assignment and for anything that is participation, for both coursework and case studies, and finally there'll be the admin team putting you in one of the 2 compulsory guest presentations. You'll be randomly chosen to attend in different weeks. So the first guest presentation is next week, and there'll be, again, so there'll be 4 presenters from the LBO side and 3 presenters from the VC side. And the list is not complete yet, but I've put a preliminary list on the hub. Okay, I will start then if there are no questions. Right. So let me start with the clarification. It's very confusing, but unfortunately, people who report on private equity are journalists, management consultants, people who actually don't work in that space. So they talk about private equity when they mean something different from what I mean, or most people in PE mean. So private equity is part of what we call private capital. Private capital is simply the opposite of public equity. So if you invest in stocks on the stock exchange, well, this is public equity. Private equity is everything else that is not. Except private equity traditionally is meant to only talk about leverage buyout. This is what I'm going to be teaching you, leverage buyout. The other space, private debt, I will talk about that because I have to. It's now merging with private equity, so I have to really talk about that. Venture capital, we'll talk about that in the next 4 weeks after the PE. Real estate, infrastructure, natural resources are subsectors of private capital. They are not usually taught with private equity because they are very specific. So infrastructure is usually, and real estate is usually invested over 10, 15, 20 years, whereas LBOs are typically for 4 or 5 years. So there are different types of private capital. Natural resources are also fairly odd. They are very cyclical, very regulated, and therefore they're not your traditional LBOs. Now, many of the PE groups, Blackstone, KKR, Carlyle, they have sub-teams that focus on that. Okay, so they have a team that, there is a fund for renewables. There is a fund, Blackstone has a fund on real estate, separate from their LBO fund. Which is why, it's part of private capital, but it's not technically private equity. However, be aware that if you read newspapers, if you read a report of Bain & Company, they will often mix up private capital and private equity, not really making a difference between the two. In my view, there is a big difference. So I should probably... Okay, so again, the first block will be about these two here. The next block will be about venture capital, right? They are separate, but they are part of private capital. So why should we study private equity? Well, I suspect if you're here it's because you have a bit of an interest for it, but you might not appreciate how important it is now for our economies, especially, not just in Europe, but obviously in North America and increasingly in Asia. More and more private equity firms are getting involved in all aspects of the economy. Personally, I think it's a risk because this is a very unregulated sector of the economy. But for some reason, governments have decided to let loose, to let this part of the economy remain unregulated or under-regulated. In this country, in the UK, 20% of private sector jobs are in companies that are backed by private equity firms. 1 out of 5 jobs. That's pretty big. If you look at M&A transactions, so if you did your corporate finance class, you know that M&A is all about mergers and acquisitions, buying, selling companies. While typically in any given year, a minimum of a third of transactions are private equity led, and in some years it's way above that, 50%, 2/3. I've seen years where it's 80%. In 2010, I think at the bottom of the last economic cycle, the Great Recession, as we called it, you'd have 80% of deals were LBO because nobody else was buying. So it was all private firms. So it is quite influential on Wall Street and in the city. If you're a banker and you are trying to get some fees, well, you're obviously going to work a lot with private equity firms because they're going to be very active. And that's the reason why, investment banking fees, if you're going to work for a bank, I guarantee you that private equity firms are going to be your key clients. Even if you're not working in the private equity team, you're very likely to have them on the other side. If you're working in one of the sector teams, you will have many buyers and sellers who are private equity firms. You look at how much they manage, 4 trillion. That's not much, 4 trillion. You might seem a lot, but actually if you look at asset management, so Fidelity, the big asset managers, BlackRock, they manage 80 trillion in the world. So 4 trillion is not much, except obviously at the macro level, because they don't invest in public equity, they only invest in private equity. It actually has a big influence in some economies in Europe and North America, and increasingly again in Asia. And what they have available, $1.3 trillion, is what we call the dry powder. So that's the capital that has been committed by the investors but not yet invested. So that's a lot of money chasing a few deals, which is why we tend to have an inflation of valuations at the moment. Because you have lots of money available and not a lot of space to invest in it. We'll see how this dry powder is being broken out. So again, dry powder, one of the first terms, I told you there'd be a lot of jargon. I'm afraid there's no way around it. So dry powder is what we call the capital committed that has not been invested yet. Again, why invest in private equity? Well, for a lot of investors, it's all about diversification, right? I'm sure you heard this term. Hopefully, if you don't again corporate finance, that will have been explained to you. If you need to invest in all different asset classes, well, as you know, for BlackRock or Fidelity, you will need at some point to invest in private equity because you want to diversify away from the exposure you have in public equity or corporate bonds or treasuries. And it's important because public equity is very volatile. At the moment, we are, as you probably know, we are in either a bull run or a bubble. But there's a lot less volatility in product because it's not as liquid. Now, if I'm buying a company and I keep it in the portfolio, the only way I can get out of it is if I can find a buyer. Whereas if I'm buying a stock, a lot of stocks are very liquid. It's different if you buy a small stock on the AIM stock market here in this country, but if you buy in FTSE 100 index or S&P 500, you have a lot of liquidity. You don't have that in private equity. So that's one way to invest in something that is of a different risk profile. We'll talk about the efficient market frontier. Again, another theory that you should have been taught in corporate finance. I don't believe in it, but because it gets taught, I will discuss it. Portfolio diversification, I talked about that. If you want to invest in small and medium enterprises, private equity is probably the only space where you'll have this opportunity. I'm ignoring, obviously, early stage, that's venture capital, and I'm ignoring very, very mature. There are exceptions, obviously in the US, it's all about size, so they get crazy as soon as a business is worth 10 billion plus, they want to do an LBO of it, but in reality, in Europe, in China, in India, they haven't really touched that space yet. They don't tend to buy very, very big companies. Usually, SMEs are the key target for private equity firms. If you want to get access to legitimate inside information, as you know, in public equity, it's completely illegal to trade on inside information. In practice, a lot of people do it. About a quarter of public equity transactions are insider trading. That's not me talking, that's proven, I would say, by research. But in private equity, you are on the board of the company, so you get inside information and it's legitimate. So if you want to get that kind of inside information, private equity is ideal. You back the entrepreneurs, okay? It's very true in venture capital, but in some cases it's also very true in private equity. You can do leveraged buyouts of companies still owned by the entrepreneur, by the family that has backed it, or the individual. The last point is very, very important. There is no leveraged buyout without debt. Typically, investors in public equity do not use debt. So if I'm Fidelity or BlackRock and I invest in stock, I will not use leverage. It's very rare to do it. Hedge funds managers do it, which is the reason why so many of them go under. But most asset managers don't use leverage. In private equity, it's systematic. You don't do a leveraged buyout without debt. Many of our guest speakers will be on the debt side. In fact, the one we have next week, I believe, from Ares Management. Ares Management is the biggest private debt fund manager in the world. There are people who used to work for Apple and they decided to go their separate ways and they set up the biggest private debt. By private debt, I mean they are not a bank. They are lending money, but they're not a bank. They are a fund manager. So it's the biggest in the world. And this is really why LBOs for them is their bread and butter. That's what they do for a living. So this is the reason why you want to invest in PE. Really diversification and lots of benefits that you don't have in public equity. I warned you on the jargon side. Now I get a lot of criticism every year, but there's too much jargon. I'll go as quickly as I can on it. It's for you to read in your spare time. If you have any questions, you come and see me after class or before class. I'm not going to bore you with all of them, but there are some basics I need to tell you about. So I've just talked about leverage buyout. The important part here is the L, leverage. A leverage buyout is either a management buyout, a management buy-in, or a BIMBO. And I'm not being rude, I'm just explaining what this is about. MBO is a management buyout. It can be confusing here. Although it's called buyout, you are using the team inside the company. With management buy-in, you are using a team outside the company. I didn't make up English, right? I'm French and we have a much clearer language. But for some reason, the English consider that
If the team is inside the company, you call that a management buyout. So the own team, the team running the company, is buying out its own business. It could be a division of a larger organization. It could be a publicly listed business, so the public shareholders are basically being bought out with the backing of a privately firm. Okay, so the team inside buys out the whole company. If you are trying to buy a business and you don't have or you don't like the management team in place, you want to buy it with bringing your own team. So I am Blackstone or Carlyle. I want to buy a company, but I don't like the management team in place. I choose my own team outside, so people who know the sector, who know that kind of businesses, and then I buy in. I acquire the business and get the management that is in place out, and I bring in my own team. Bingo is a mix of the two. So you like the CEO, but you don't like the CFO of the existing management team. You fire the CFO, you bring in your own CFO. That's a bingo. Buy-in, management, buyout. Okay? A bit more. Owner buyout. Owner buyout are very common. In this country, the one that is very well known because it was all over the press is BHS, bought out by Philip Green. Sir Philip, the company went bankrupt, used too much leverage, basically. BHS was a big department store similar to Debenhams. I will probably go bankrupt within 5 years. And Marks & Spencer, I give it another 10 years. Department stores are dead, basically. Not just because of Amazon, but because simply they are trying to sell everything to everyone and it doesn't work. Right. So BHS was one of the biggest OBOs in this country. There's one owner buyout manager you know very, very well. His name is Donald Trump. Donald Trump did 4 or 5 different buyouts on his own books, you know, in his life. He went bankrupt 4 times, probably know that. So Donald Trump, running the biggest, most powerful country in the world, arguably, did a lot of OBOs in his life. Trump organization has done lots of them in casinos, in hotels, and it's very, very cyclical industries, very risky, very regulated, and that's the reason why when you put a lot of leverage in a sector that is very regulated and is very cyclical, you take big risks. Obviously, if it's not your own money you're investing, it's even better, right? So fund managers do go bankrupt all the time, or at least they portfolio companies, but it's not their own money, so they don't care that much. When it's your own money, it doesn't look good. So Philip Green got a lot of, got given a hard time, and Donald Trump also was criticized many times for going bankrupt so many times. But in the US, they forgive you, right? You go bankrupt, you get back on the saddle, go bankrupt again, get back on the saddle. It seems to work over there. IBO are the opposite. There is no owner, there is no management team, there is nobody there. You are doing the buyout. You, the fund manager, are buying out the company without a team in place. The one that I've mentioned 2 years ago, I did the case study of EMI Music was an institutional buyout. Terra Firma in this country, a big fund manager, bought EMI, didn't like the management team, didn't have a management team to replace them, fired everybody, and then they made it up as they went along. You'd be surprised to hear that they went bankrupt. So IBOs are very risky because if you don't know the sector, and Terra Firma didn't know music, they had never invested in music before, it's a very big risk. So if you do IBOs, you better know the sector very well. SBOs, secondary buyouts, not to be confused with secondary transactions. We will explain that in a second. I will separate the two. Secondary buyouts are, I am a fund manager, I sell my portfolio company to another fund manager. These are very common. About 50% of transactions are now secondary buyouts. Because they've run out of targets, they've got too much fund, too much money, too much capital, so the fund managers are struggling to find targets to acquire. So they acquire them from other fund managers. We call that pass the parcel. So you have a parcel, you don't know what to do with it, you give it to someone else who's also a fund manager, who give it to someone else. So now secondaries have turned into tertiaries, quaternaries, quinternaries. I don't know what you say when it's 6, but basically we are moving on and on now. So you've got generations of companies moving on from one fund manager to the next. Yes?
What's the difference between selling to another fund manager and someone else, like in general?
One is just called a straight out sell. So if you sell to, it's called a trade sell. So if I am, let me try and think. So if you look at KKR, they bought Allianz Boots. If you go to Boots in this country, so Boots used to be owned by KKR. KKR sold it to a company in the US called Walgreens. Walgreens is similar, a chemist in the US, a chain. So that's a trade sale because I sold to a company that is not a fund manager. But if I sell to another fund manager, it's called a secondary buyout.
So it has different names, but
Yeah.
it doesn't change anything in their weights.
It changes the fact that Walgreens didn't use as much debt, right? So it's no longer a leveraged buyout. It's just a straight sell, and so Walgreens buys it with its stock or with equity, or you can borrow some debt, but it will never be as leveraged as a leveraged buyout. Any other question? Okay, some more jargon. I apologize. Public to private, very common as well. So if you're a fund manager, although typically you buy a private company, sometimes the target you have in mind is in the public sector. It's listed on the stock exchange. I just mentioned Boots. So KKR delisted to private Boots. Boots used to be on a FTSE 100 component. So they bought Boots and took it private. That's what we call public to private. So you take a public company and you take it private. PIPE is when you try to take a company private, but you fail. Because to take a company private, you need to get to a point what we call the squeeze-out level. The squeeze-out level it differs in all countries, but typically it's around 90-95%. In this country it's 90%, in Switzerland it's 95%, in France I think it's 95%, in the US it's 90%. So the squeeze-out level is the point where you can squeeze out the minorities. If you don't get to 90% acceptance from the public shareholders, you can't delist the company. So you end up with a private investment in public equity, a PIPE. So I mentioned some of the books that I recommend you read. In my second book, in The Debt Trap, I mentioned Siad Paggiale and Pajon. They were both PIPEs. So the companies, KKR and Pajon, trying to delist that company. It was listed in France. They failed and ended up in the PIPE. Okay. Here I basically explained that, what we discussed before, the MBO, the MBI. I will explain in a minute what we mean by general partner, but general partner is a fund manager. That's a different term again that we use for it. A company that, an institutional investor that provides capital to the fund manager is called a limited partner. The fund manager is called a general partner. The fund managers, as I mentioned, do not manage their own money. They manage other people's money, OPM. That's what we call it. So if you're not managing your own money, you have to take it from someone else. That someone else is called a limited partner. I will go through it again in a while, but that's basically what the LP is. LP is limited partner. Any questions? Too many? Okay. All right, I'm going to go through some of the structures. I'm warning you, there are a lot of structures in private equity. It's all about creating new structures to buy companies. It will make sense as we go through a lot of them. So here's one of the structures that you need to be familiar with. I've mentioned limited partners already at the top. So they can be pension fund managers. We'll go through a list of who the LPs are, but they are rich organizations. They can be sovereign wealth funds. The biggest ones obviously is in Norway, but you have plenty of them all over the world. Most governments have a sovereign wealth fund and then invest their money in public equity, in treasuries, and also in private equity. So typically, you have a limited partner that commits capital to different GPs. You can obviously have lots of LPs investing in GPs. KKR is not going to raise money from only one LP. It will invest from lots of different LPs. And KKR is the general partner. PAI partners, Apax are the general partners. They have lots of, so when I mention Carlyle, Blackstone, TPG, Apollo, these are general partners. These general partners manage vintage funds, so they raise money. Now here I've got KKR 2006, and then they raise another one, say in 2008, and then they raise another one in 2014. So these are the vintage funds. That's what we call them. And from these funds, they invest in portfolio companies. So typically, a fund will have between 6 and 12 portfolio companies. Okay, you're not going to put all your eggs in one basket. Although that's one of the mistakes that Terrafama made with EMI. They put 30% of their funds in one company. The company went bust. And Terra Pharma is obviously not able to raise any more funds. So that's because they made a mistake. They concentrated their money into only one big portfolio company. So you want to invest in lots of them. I mentioned secondary buyouts. There is another term called secondary transactions. We have one of the speakers coming here, Coller Capital, the biggest secondary fund manager in the world. Coller Capital buys positions from LPs into GPs. That's what we call a secondary transaction. A secondary buyout is I am trying to sell this portfolio company to, so I'm KKR, and I'm selling my portfolio company to PAI or to Apax. Okay? That's a secondary buyout. Secondary transactions is at the LP level, the secondary buyout is at the GP level. More structures. So let me go into some of the details of how that relationship between LP and GP works. The limited partner, so I mentioned here some examples, pension funds, insurance companies. I'll go through the full list in one of the other slides. Family offices, some of my clients are limited partners, although they try to invest directly now to avoid what we're going to talk about now. If you are an LP and you commit capital to a GP, you have to pay them an annual fee of 2%. Now it's counterintuitive because let's imagine you have an asset, you have a flat here in London, and you decide to rent it out. Are you the one paying 2% to the person renting it out, or is the tenant paying you? Usually the tenant is paying you, right? Well, that's in private equity. In private equity, if you provide your assets, your capital, to the GPs, the GP charge you for it. They charge you a management fee of 2%, typically. I mean, the management fee can vary. We'll see there's a lot of variation between them, but you typically, on average, you charge 2%. So in exchange of the 2%, the GP invests that capital you committed. And invested in deals, right? So I mentioned the portfolio companies. All these deals here are invested directly by the fund manager. Now, if you go back to the previous here, we've got the GPs. They're the ones investing through their funds. So that's where we are here. So I invest in deals, and these deals, I typically send them an average of 4 to 5 years. Sometimes it takes a little longer to get out. Sometimes I'm able to do a quick flip, as we call it. I'm able to get out very quickly within 2 years of investing. I'm out already. So the objective is to generate, obviously, capital gains. I want to sell these companies at a higher valuation than the price I paid for them. If I do that, I generate capital gains. 80% of the capital gains go back to the LP. 20% stay with the GP. So the GP gets what we call the 220. 2% management fee every year, 20% of the capital gains. That's the 220 rule that applies in hedge funds, in VC, and obviously in private equity. Now bear in mind, sometimes you have variations. I know some hedge fund managers who were able to charge 440, 4% every year, 40% of the capital gains. They are the best, right? The guys who are really, really bad, they charge less than 2% and they only charge 10% of the capital gains. But typically the 220 rule applies to most participants in the sector. So that's how it works. The LP commits capital to the GP invests that money into deals, and then when they sell the companies, they generate capital gains, hopefully, and they get 20% of the upside. 80% goes back to the LP. I mentioned secondary transactions. So I've got the original LP, the limited partner, and I have, say, Coller Capital, one of our guest speakers, decides to take a position from the LP into one of the GPs. Now, the reason why they won't do that is because, say, they need some capital. So these guys here, remember, they committed the capital here in the GP. That capital is committed for a minimum of 10 years. 10 years is a long time. Imagine we are in 2009, 2010. I am the LP here, and I'm desperate for cash, I'm about to go bankrupt, one way to survive is to sell some of the positions I have here. Of course, you go through a valuation exercise, and you value your position there, and obviously the way you value it is that you value every single portfolio company under it, and you decide, okay, based on that valuation, I sell at a slight discount, usually, but sometimes it can be on par value, and I sell my position in that GP to that secondary LP firm, right? So if I'm CalPERS here, one of the biggest pension funds in the world, based in California, and I've got Coller Capital in front of me, I tell them, okay, I've got a position in KKR, I need to generate some liquidity, I can't wait 10 years to get my money back, I'm happy to sell at a discount my position here, and Coller becomes the new LP. Yes?
Don't the LPs keep a capital buffer when they invest, just in case they need liquidity?
Absolutely. In fact, that's the way they're supposed to do it. The problem is the buffer in 2007 looks very different from 2009, right? So when right now we're more or less in a bubble, most people agree with that. We don't know whether we're at the beginning of the bubble or at the end of it. Right now, people are thinking, I'm going to keep my buffer at say 10%, 20%. But that buffer might shrink, right? If the valuations go down, and most LPs, as I mentioned, can be invested in public equity in treasuries. If the valuation of public equity collapses, say we have a crash, equity crash, 30% down. It happens a lot. That's what happened in 1987. That's what happened in 1998 during the Asian crisis. And frankly, that's what happened between September 2008 and March 2009. So you lose 30% of your public equity valuation, your buffer is gone. So you are desperate because you have capital commitments. You have to select. Remember, these LPs are invested in not just one GP, they're invested in sometimes hundreds. CalPERS had 150 in 2007, 150 relationships with GPs, just in private equity. And CalPERS also invests in venture capital, public equity, treasuries. So they have literally hundreds of relationships with fund managers. Some of them are calling the capital. You have a capital commitment. Okay, you committed for that fund. I need your money. If I don't have the money, I need to sell some of my other positions. Otherwise, I will default. If I default, I could either end up in court and have to pay a fine, or I could even be forced into bankruptcy because I have a liability I can't meet. If I can't meet, then technically I'm bankrupt. So the buffer, unfortunately, can be squeezed in a crisis. Any other question? All right. There are 4 stages to private equity, and actually it's true for most fund managers. You need to raise the money. So I've mentioned obviously that relationship in GP and LP. So I need to go to all the LPs and I need to find enough of them to raise my money. So let's say I want to raise $1 billion. That's the target for my fund. I usually have a hard cap, so I could say, $1 billion is my target. I'd be happy to go a little bit above 1.2, 1.25 billion. And so then after that, I have to go and meet lots of different LPs, what we call a beauty parade. We meet them all, and you try to motivate these people and convince them that you're going to be a very good investor. So this is what you do fundraising. We're going to go through each stage. After that, you have to invest that money. Please note that when you raise money, that's what's confusing. And very often when I read the press, I can tell the journalist doesn't know what he's talking about. Fundraising doesn't mean that the money is in your pocket. It's a capital commitment. The LP has said, okay, I'm committing 100 million to your 1 billion. So when you need the money, you call me and I give you 10% of the deal, right? So if I want to acquire a company, that company needs $150 million of equity. Well, 10% of that 150 will come from that LP that committed 100 million to my fund. But that's just a commitment. It's not given yet, which is why sometimes you thought you had enough money, but suddenly there's a crisis. You don't have enough money. You can't meet that commitment. But once you have that commitment, you can invest in portfolio companies. So you look for deals, you look for targets, and you acquire these businesses with the equity and obviously the debt portion. We'll talk about that. Then that company sits in your portfolio. Yes, sorry.
How do funds prevent investors from backing out from their commitments?
We'll talk about that, but there's something called a limited partnership agreement. You sign an agreement, it's legally binding. If you default, I can go to court against you. And it happened. So you have it, once you're committed, it's like any other contract. I can take you to court. Monitoring portfolio companies, again, for several years it will sit in your portfolio. You're the fund manager. There's a reason why you're called manager. You have to manage that portfolio company. You have to make sure you create value. The objective is to create capital gains. Remember, you get 20% of the upside. So if you don't generate an upside, if you don't manage well, then obviously you're not a very good fund manager. You will not raise another fund. So you need to create value here, and then you need to divest. You need to exit. You can have lots of great profits on paper. If you're not going to be able to get out, if you're not able to find buyers for your companies in portfolio, then clearly you're not going to generate capital gains. If you can't divest, if you can't get out of your positions, then you're stuck. So once you've divested, you return the money, the proceeds to the LPs, the 80% we talked about, and then you keep 20% for yourself, and then you go back into the fundraising mode. You keep raising more and more. So if you're a successful fund manager, you'll be able to raise more money. If you're not, like Terra Firma, you will never raise again. So it's a risky game. Let's talk about the fundraising. So, I know some people asked questions already. So, how do you raise money? As I mentioned to you, it's all about practice. So, if you end up working for a private firm, you could be on the fundraising team. When I was at Carlyle, I was on the investment team, but we had a fundraising team. These guys all day long would focus on fundraising. They meet the LPs. They manage the relationship with them. So fundraising is done typically every 4 to 5 years. You don't raise all the time. You have to invest that capital, and then once you've proven after a few years that it's going well, then you can go back on the road and ask for more money for a new fund, a new vintage. Now, typically when you have a crisis like the one we had in 2009, it can take you 6, 7 years, or even 8 years before you can raise the next fund. And typically, when we are in the bubble like we are now, after 2 or 3 years, you can go back on the road because people are so eager to commit capital because they have too much money to spend. They're happy to commit to you, even though your previous vintage hasn't really generated any capital gains yet. People take more risk when we're in a bull run.
So when you just raise money and there is small fractions, not the time market, so then you buy a cheaper company.
Yeah, but your portfolio companies are worthless, right? So bear that in mind, you're right.
Then you expect the crash to go over by the time that you have to invest again.
Yeah, I agree. Nobody knows. Now, the last recession, Great Recession, people thought, are we getting into a depression, in which case it would last 10 years, or are we going to be in a short recession? In practice, it was a medium-term recession, right? It lasted probably 3 or 4 years. By 2012, we were probably getting out of it. But 4 years is a long time to invest. Remember, I haven't explained it yet, but you have a certain time to invest your money. You're not given forever. So although the LP is coming for 10 years, you only have 5 years to invest that money. But I will explain that in a second. So you use what we call the private placement memorandum, the PPM. So the fundraising team prepares a document. It's a marketing document that explains everything about the team. Who are the GP team, the fund management team. So who are the senior people, the people who matter, who will invest the money. What's your track record? If it's not your first fund, you have to explain why you think, based on your track record, that you will be very successful going forward. You explain your strategy and your approach. So are you going to invest in distressed assets? Are you going to invest in a typical one sector? Are you going to invest in companies between 100 million enterprise value and 1 billion? Are you going to invest in the UK, or Europe, or global? Now, all this you explain in the PPM. You have to, because you will attract different LPs depending on your strategy. Some LP partners want to diversify. So if they want a UK fund only, then ideally, they will invest in you if you only focus in the UK. When I was at Carlyle, we had a fund for Japan, a fund for China, a fund for Africa. So we had separate funds depending, and I was part of a European fund. So, and I was focused on technology. So our fund was European technology. And you invest in that sector and in that region. You don't go and suddenly invest in the Middle East because you think, hey, there's a great opportunity there. No, it doesn't work that way, because the LPs have committed capital to you based on the strategy that you've described in your PPM. I've mentioned a track record, but you also do a benchmarking analysis. You have to benchmark your performance to your peers. Now, it's not an exact science. In practice, I can tell you that there's a lot of manipulation of data. Everybody does it. It's a marketing document. So although it's kind of legal, you kind of take out the outliers. The guys who perform very well. You don't want them to be in benchmark. So there's room to maneuver there. But in practice, you do a benchmarking analysis, and it's for the LP to not be too naive and to do their own benchmarking analysis. You explain the team, not just the investment team, but also the investor relationship team, the RR team. Okay. As I mentioned to you, at Carlyle, we have a separate team on RR. Most funds have that. Not all funds have a fundraising team. So at Carlyle, because we were so big, we had our own separate team. Sometimes the fundraising team and the investment team are the same. So when I worked for UK funds, they were much smaller, and I was doing the fundraising and the investment. So that was very time consuming. So as I mentioned, once you launch the process, although the fundraising happens every 4 or 5 years, it takes several months between the time when you launch the fundraising, so when you distribute the PPM, and the time when you finally get the commitment. It can take several months. Now, at the moment, based on what the discussions I have with my former colleagues, it's very easy to raise money. So it takes 6 months to a year. But in 2009, it took sometimes 2 to 3 years. So you're on the road meeting people and they don't want to commit because they're nervous about the economy. So very much dependent on the cycle. It's a very cyclical industry. And here's the proof in the pudding. Very cyclical. So when the economy goes very well, you can raise money very easily. I'm told 2017 was a record year. Maybe not as high as 2008, but it'd definitely be higher than this. Remember, bear in mind, 2016 was unusual because if Donald Trump hadn't won, we would be here. The last quarter of 2016, people panicked. They were not quite sure what Donald Trump meant for the global economy. I don't think we still do, but people have got used to it, right? So it's like everything. You get used to the plague. So 2017 was a very good year because people thought, what the heck, we'll take a risk. So they've raised a lot of money. Well, I haven't got the numbers because Bain and Co. take a bit of a lag. Obviously, we don't. We're in January 2018. We don't know what happened last year, but it was slightly higher than 2016. So it could be that we are, 600 billion of fundraising. And please note, I told you at the very beginning that people get confused about private equity and private capital. This, to me, is about private capital, and yet it's called global PE capital raised. So Bain and Company call this private equity, but it's not, because buyouts are separate, and then you have real estate, infrastructure, venture capital. So to me, this is private capital. So this is all the fundraising in private capital. And still, you can see that the fundraising is going up. So we are getting close to the levels that we saw in 2007, 2008. Which is not surprising because the stock markets are doing very well, so people are generating loads and loads of capital, and they have to put their money somewhere. There's another reason why there's too much capital in the system at the moment. Hopefully you are all familiar with quantitative easing, QE. You're familiar with it. I'll explain it to you very quickly. Central banks were very nervous about the Great Recession becoming Great Depression 2.0, so they decided we have to inject a lot of capital in the economy. The way to do that is to do quantitative easing. What that means is that the Fed, in the US, the central bank here in Europe, Japan was very active as well, Japanese central bank, and obviously the Bank of England, they all bought bonds, primarily treasuries to start with. Then it wasn't enough, so they bought some corporate bonds, and Japan started buying equity. So what that means is that the central banks put on their books a lot of these products. They bought them. They bought treasuries, they bought corporate bonds, they bought equity. And obviously people that were holding onto these products, in exchange for these products, they got cash, right? If I own treasuries and suddenly the central bank says, I'm going to buy the treasury you have here, I give you my treasury, and then you give me cash. Where do I put that cash? Well, I put it somewhere else where I have to find another product. So I put it in equity, or I put it in other corporate bonds. I find somewhere to put them. I put them in private equity as well. So that QE that was really done on a global basis, in my view, is the reason why we are in a bubble now. It's because the central banks didn't know where to stop. So in my opinion, and I think it's the opinion that's shared by a lot of people in the city, they went too far. They put too much of it. They should have stopped in 2013 and 2014, but they didn't know where to stop. So I think right now the Fed is the only one that stopped. The European Central Bank continues to do QE, the Bank of England continues to do it, and the Japanese bank also does it. So, Bank of Japan, sorry. So you are looking at a bubble that is being created by central banks. Really, all that money that is being coming into, invested here in PE is treasuries, bonds that were acquired by central banks from all these LPs, all the institutional investors that need to find another place to put that money. So they put it in PE and other parts, not just buyouts and VC, but also in stock markets. So stock markets are at the peak. Last year, the big 5 tech companies, we'll talk about them in VC, in the VC blog, but the big 5 tech companies last year saw their stock go up 50% on average. I think Apple went up 75%, Amazon went up 60%. I mean, we're talking big jumps here. I mean, I'm sure, they are great companies, but, are they worth 75% more at the end of the year than they were at the beginning? I'm not so sure. But that's just capital that needs to find a home. So people say, I might as well put it in tech companies. They're the future. Okay. And that's really what happened here. So 2017 was a good year. And this is dry powder I mentioned to you before. So, we have about 1.3 trillion. That's 2015, but, it's obviously a bit similar now, maybe a bit more. And that's really, as you can see, the split here, buyouts are here. So it's, every area is having an increase in dry powder. There's more and more capital committed, but not finding a home yet. So the more capital you have going up, the more of a bubble you're in, yeah? Because unless you assume that valuations are going to go up, or that a lot of value is going to be created from companies that are going fast, if you have too much capital and not enough opportunities to invest it in, you will pay more for the assets that you are targeting. That's why valuations go up. That's how you create a bubble. Okay, limited partners. I mentioned to you some of the categories, but this is a long list. In my view, most of the typical LPs are in there. So I mentioned corporate pension funds. So corporate pension funds, every big corporation has a pension fund, whether it's Apple or British Airways or any big corporation needs to create its own pension fund for its employees. Public pension funds, I mentioned CalPERS already. So CalPERS deals with public employees in California. All governments tend to have a pension fund. That's where you pay Social Security in most countries. Endowments, so that's universities. So most universities in the US and some of them in the UK have an endowment fund. That fund tends to invest in all categories, including private equity. Foundations, so they're usually charities, but many of them can be from rich families that decide to, for tax reasons, create a foundation because it's not taxable. So for example, the Hilton family, I know you guys know Paris Hilton, but there is a family behind her, a little more meaningful. So if you know Paris for a second, the Hilton family is very rich. They have over $1 billion under management. They've created a foundation, and that foundation invests in all kind of assets to obviously create value so that they can back causes that they believe in. So they invest in private equity as well. Obviously, the banks are big investors. Wealthy families, they're my clients. Sovereign wealth funds, so I mentioned some of them. Norwegian fund has more than $1 trillion under management, so they invest in private equity. But every, Abu Dhabi has got a very big fund. The Singaporean government, GIC, has got a big sovereign fund. So they are very big in private equity. In fact, I recommend you guys, depending on which country you're from, you should definitely target these as a potential employer, because in my view, increasingly in the future, they will try to invest directly. Many of them have been pretty unhappy with the way the fund managers behave. Some of them don't behave very well. They overcharge on fees. They lie to them. As I mentioned to you, we can play with the benchmarking analysis, but we can play with a lot of things, believe me. So it's pretty easy to cheat people who don't know what they're doing. So many sovereign wealth funds now are bringing in talent in-house to try and invest directly. Insurance companies also invest. Investment banks, I've mentioned, non-financial corporations. Any big corporation that wants to invest directly into private equity can do so by selecting GPs. And finally, any other investors I've mentioned, Coller Capital, the secondary fund. There are lots of secondary funds out there. So that's really the typical limited partners. So you asked me a question about, well, in practice, yeah, you commit capital, but are you really legally bound? Yes, you are. So you sign what we call a limited partnership agreement. That document is legally binding. It's a document between the GP and its LPs. So typically a fund, now when I worked at Candova, which was one of my UK employers, we had something like 110 LPs typically in one of our funds. So you can have over 100 relationships, LPs invested. So if you're raising 1 billion, you can have people putting 10 million, others putting 50 million. You have lots of different LPs, different sizes, and different commitments. So all these relationships you have to manage. And this is really managed through this agreement. All the LPs are linked to it. In there you have a duration. Typically I mentioned it's 10 years. So you commit your capital as an LP for 10 years. Possibility for extension. Typically it's renewable by 1 year, 2 or 3 times. So you can have, you can typically, have a fund that goes 12 or 13 years. We will see that most funds are never returned within 10 years. It's very, very rare. It's the minority. So even though the structure is 10 years, it's very difficult for GPs to return their money within that timeline. You explain the capital and loan commitments. So not only can you commit capital if you're an LP, but you can also commit debt. You can provide loans. So it's not, although it will be invested in the shape of equity, the structure of the instrument can be a loan. The due diligence cost. So as a fund manager, you will incur cost to diligence the investments. You're just not going to invest randomly, although I have to say some fund managers look pretty incompetent, but you're supposed to do due diligence. You're supposed to spend money on accountants, consultants, lawyers, financial experts that will help you analyze the companies you're trying to acquire. So these due diligence costs are mentioned in the LPA to know who is going to bear the cost. Typically it's the LP. Set up costs, obviously. Management fees, that's the 2% I mentioned to you. We'll see that there is variation or variance in the fees. The preferred return, that's the hurdle rate. We haven't talked about that yet. Another jargon. Typically, you commit to a minimum annual return to your LPs. Product is supposed to be higher return. The reason why it's higher return is because we leverage. I will explain to you the impact of leverage. Hopefully, when we do session 3, you'll start getting an understanding of why leverage is so important for new firms. Because you are guaranteeing a higher return, you provide a hurdle rate. The hurdle rate is typically 8%. What that means is that if you don't return an annualized rate of return of 8% of the life of the fund, you will not get your 20%. Remember I told you the GP gets 20% of the capital gains. It only gets 20% of the capital gains above the hurdle rate. So if I annualize my returns and I don't generate 8% for my LPs, I get 0.
But you get the management fee?
Yeah, management fee. Now typically, there have been some analysis, but people are not quite clear about the output, but 50% to 2/3 of fund managers never hit the hurdle rate. That's incompetence. I tell you, a lot of people make money on fees. That's the game. I know a lot of my former colleagues who became millionaires, multi-millionaires, just on the fees. It's great if you can get it, right? But I think that's important to realize that it's like a lot of, I'm sure you're familiar with the 80-20 rule, right? 20% of people generate 80% of the gains. That's very much applicable in private equity. So the key fund managers, the guys the successful ones, Carlyle, KKR, Apollo. KKR is not such a great performer, but they're still alive. My view is that the reason why they are doing well is because they are meeting the hurdle rate in most cases, and the ones that disappear you never hear about, the Terra Firma of this world, don't hit the hurdle rate and they disappear very slightly, but they've made fees in the meantime. Yes,
Do you mean 8% IRR or 8% in terms of CAGR?
IRR. We explained the IRR, yes, that's why I didn't mention the word, but you're right, it's the IRR I'm talking about. I will explain to you what the IRR is, so don't panic yet, it's another jargon, but that one is pretty important. So this is the hurdle rate. Okay? So, and then you mentioned the carry. I mentioned the 20% capital gain is called the carry, or carried interest. Another jargon. I apologize, I know you hate me by now, but I'm afraid I have to use these words. So the GP's carry, the 20% is mentioned here. Again, I mentioned 20% is the typical number, but if you are a very, very good fund manager, if you've got a great track record, you might ask for more. You might ask for 25%. Some PE firms even go for 30%. And then you have the appointment and removal of GP. So the terms when you can say, listen, you are so rubbish that we can fire you. Typically, you need 75% agreement from the LPs. So the more LPs you have, the more difficult it will be for them to do that, right? So that's why you want to have as many as possible. You dilute. It's the concept of divide and conquer. So the GPs tend to have as many LPs as possible because they don't want them to have that 75%. I've known situations where the LPs try to get 75% and they fail. So that makes a very complicated relationship going forward, right? Because the LP has tried to fire the GP managed to keep that agreement below 75%, so they remain the fund manager. It doesn't make for a very healthy relationship, but it happens. Okay? So LPs try to fire GP sometimes when they are really big underperformers. Bridge financing. So this is a bit controversial. I don't want to go into too much detail because I won't interrogate you on this one. What happens is that you are, because of the RRR we just discussed, you are trying to get as quickly as possible to your 8%, right? And we haven't discussed time value of money yet. Hopefully you have discussed it in other classes. Don't worry, I will cover it later on. But you want to generate your returns as quickly as possible. By getting a subscription line financing, that's what you're able to do. What is this? You have a capital commitment, and as I mentioned to you, in some cases, it might take a few years before you draw down that money, before you have opportunities to invest that cash. So what you might want to do is get to invest earlier by borrowing. Again, you are leveraging your fund, even though you're doing leverage buyouts as well. So it's double whammy. You're leveraging a leveraged vehicle. This is what a subscription line financing is. So the LPA should mention whether it's allowed or not. In many cases, it is allowed. It allows a GP to borrow money from other parties, so a bank, for example. That money is actually the equivalent of your capital commitment, but they don't draw it from you. For now, it doesn't make sense to you. I will explain later to you why you would want to do that, but the RRR is calculated from the point where you draw down the money. If you're not drawing it down, but you're borrowing it from somewhere else, and you're only drawing it down a few months later, you've managed to improve your RRR slightly. So I will explain again why it's important, but the RRR is very sensitive to time value of money. So that's the reason why you do that. So again, week 3 will make sense of all this. Co-investment rights. Are the LPs allowed to co-invest directly with the GP? Why is it important? It's because when you co-invest as an LP, you don't give the 20% carry. Right? You are a co-investor alongside the GP, and therefore that portion of your capital is not subject to the carry and the management fee. So a lot of LPs say, I want the right to co-invest. I want you to call me whenever you need more capital than you actually have available, and I'll be happy to co-invest directly with you without having the 220 impacting my returns. Many LPs now want it as a condition in the LPA. They say, I'm not going to invest in your fund unless I have the right to co-invest. Now, in practice, if you're the GP, you're not going to give your best deal to the LP. Of course, you're not going to tell them that. But what you do is you do the co-investments when you realize, I'm not quite sure about that deal, so why don't they just bring these guys here? Because my returns won't be very high anyway. So you'll do it for the deals where you know it's going to be difficult to reach the hurdle rate. And then you obviously have transfers, what I mentioned to you, the secondaries, right? So if I'm an LP, I want to make sure that I can transfer my stake, my capital commitment to another LP. So I want to be able to do secondary transactions. So this is mentioned in the LP as well. Termination terms, that 10-year and then 11 years and 12 years, you need to determine how you can terminate the relationship. The reporting on a quarterly basis, the GP reports to the LP, telling them this is what we've done last quarter, what deal we've done, all this is mentioned, and obviously how the portfolio companies are performing as well. This is what the reporting does on a quarterly basis. And governance, you have usually an advisory board, and on that advisory board, the LP, the key LPs, usually the ones that have committed the most capital, or the ones that have been considered to be the best, the experts by the other LPs, sit on the advisory board and meet once a year. And during that meeting, obviously, they can ask as many questions as they want to the fund manager, question the decisions and how the investments are taking place. I've mentioned that before. These are capital commitments. They're not investments, and they are only drawn down when required. So if I have raised a fund of $1 billion, I don't have $1 billion in the bank. I have commitments of $1 billion. I will only draw down when I have found investment opportunities to invest my money. Okay? Questions? We have 5 more minutes and then we'll take a break. What are the principal fund terms in the LPA? So I've talked to some of them already. So the 10 years is already mentioned. 2 to 3 year extensions, 1 year at a time. So you have to negotiate pretty big. Usually you negotiate a reduction in fees. So the LP can say, well, it's all very nice, but I don't really want to keep paying you 2% on the capital invested, so I'll give you 1% or 0.5% for every year extension. So you charge me less on management fees. I've mentioned management charge 1 to 2.5%. They vary a lot. The carry interest, we talk about that, 20 to 30%. Typically, it's 20%. It's 30% are really for the best funds. Preferred return, we talked about that, hurdle rate, typically 8%. It varies as well. The fee sharing on transaction cost, so that's the due diligence we talked about. Can you charge? Sometimes the GP charges the company they acquire a fee for what we call transaction fee. Right? So it's a way for the fund manager to put even more money in their pocket. And so LPs are not very happy about that, because obviously any money I charge on the portfolio company is money that will not go back to the LP, right? I'm impacting the business, the underlying portfolio company. So typically I have to give back some of that fee to the LP. And that really, the LPA will determine, do I give back 50% of the fees, do I give back 80% of the fees? That's really where I happen. Key man clause, who are the key individuals in the company that if I lose them, the LPs have the right to walk away from it. So if you are KKR and Harry Kravis is run over by a bus or crashes his private jet, more likely, well, he's going to be a key man, right? He's one of the keys in KKR. So clearly, LPs would say, I have the right to withdraw my money if Harry Kravis dies or retires or whatever. So that's really what the key man clause is about. But by the way, all the fund managers have it, not just in private equity, in VC, in hedge funds. You're giving your money to a fund manager. If that fund manager disappears, you won't be able to withdraw your money or your commitment. Clawback clause. Clawback clause is, I have committed capital. You are generating capital gains. You, the fund manager, you have met the hurdle rate, but unfortunately, you met the hurdle rate over the first 5 or 6 years. Again, we haven't talked about time value of money, but the more I wait, the more difficult it's going to be to meet that hurdle rate. So if suddenly I'm stuck with 3 portfolio companies at the end of the life of the fund, and I can't get out of them, I'm going to miss that hurdle rate. And therefore, even though I have distributed 20% of the carry on the early days, suddenly for the last remaining 3 deals, I'm not going to be the hurdle rate. A clawback gives a right for the LP to recover some of the carry you have been distributed before. Okay, so typically this is what you have with the clawback clause. You're allowed to claw back some of the capital gains that have been distributed to the GP. And reporting governance, I talked about that already. Okay, you can take a break. One question. Sorry guys, there's a question, you can take a break.
It's just a quick one. In terms of the key-man clause, are you allowed to withdraw only the committed capital, or are you also allowed to tell the GP to liquidate part of the investment that's already been deployed?
You can't liquidate if there is no buyer, right? So you can't force a liquidation. All right, take a break. Well, your participation will be based on the participation. Whether you participate in morning or afternoon. What I will ask you to do is, we explain again, but you will have a name tag. I'll ask you to turn the name tag. Otherwise, you will turn it to 16. So I'll be able to see it. That's fine. I'm already given a list of what you guys will follow. Because what will happen is you hand back and I will test
j'ai un interview cette semaine et la semaine prochaine avec Parker Group. Il m'a dit que ça va être 3 interviews à la suite, par téléphone, une demi-heure, 10 minutes sur moi, 10 minutes ça va être technique, mais on m'a dit que c'est relativement simple. D'accord, donc c'est IRA ou EV, donc voilà. Ça je suis en train de préparer en ce moment, après c'est 10 minutes et je peux leur poser des questions. Donc j'ai un associé et après j'ai un junior. Pour l'union, je pense que ça va aller parce que je peux utiliser aussi par rapport à moi. Mais je sais pas ce que je pourrais demander à l'associé. En fait, j'ai vraiment commencé à utiliser ce que vous avez fait là dans la semaine dernière.
Les gens sont à la fois un LP et un GP. C'est le LP, vous voyez,
j'ai aussi des petits notamment.
Ça fait des possibles différentes en fonction de ce qu'on va montrer. Les questions que je poserais pour moi, ce serait des questions sur comment vous allouez, comment vous décidez quel GP vous choisissez, des choses comme ça. Quelle est votre stratégie en termes d'investissement? Est-ce que vous sélectionnez des régions, des secteurs? Des questions qui sont spécifiques des GP. Si les GP vont en montrer, c'est plutôt quel secteur, quels sont les critères de sélection que vous prenez pour des investissements actuels. Mais je pense que plutôt le LP.
Honnêtement, on ne m'a pas encore dit, mais j'ai vu que c'était très large et que tout. Vu que je viens de l'asset management, pour moi c'est vraiment nouveau.
Ouais, mais c'est similaire à.
Ouais, c'est la même approche.
Je me demanderais quelle est la stratégie.
Si vous avez d'autres conseils,
je vais y réfléchir, ouais, mais je connais ces investisseurs qui avaient tout dans l'année.
ils sont relativement bons.
L'équipe de Suisse de Londres.
C'est là-dessus. Je viens de Suisse.
Ah oui, d'accord. C'est un très bon groupe.
Parce qu'on va dire, on verra justement, c'est belle chance.
Un français du coup.
Mais en même temps, les conseils
Non, moi je pense que c'est une discussion sur la formation.
Bah, là, en tout cas, modèle, etc.
Moi, je nous, les gens déjà, quand ils veulent savoir qu'est-ce qu'ils préféraient pour 2-3 ans, à savoir fonctionner. Il y a plein de fonds qui ne sont pas connus, donc on ne peut pas sélectionner en fonction du nom, parce que très peu de il y a très peu de noms qui sont connus.
Par rapport à un
Si vous voyez, ça dépend en fait. Vous cherchez ensuite si vous voulez global, évidemment, il faut global, mais honnêtement, je
mais non, parce que
ils ont changé récemment. Ils ont produit aux US. En Europe, je ne suis pas sûr, mais en US, ils sont en train de ça dépend en quel secteur.
non, mais moi j'étais en stage là-bas, j'ai vraiment.
Lui, dans une boîte,
Les gens sont des gens très simples, très sympas. J'ai quand même postulé à tous les seminars,
non, mais là, c'est ça.
Well, you can present now. It's not a case presentation, it's a presentation. So if you want to, you will have to send enriching documents. So if you look at the cases, there are questions. You need to answer these questions on the written. You will submit a paper on the hook, and then I will look at them, and then you can use them to participate in class. So, if you have written the answer, you can participate in class with it. I will use the written as well as part of the participation in class grade. So because you have 260 students, so not everybody is going to participate. So I will use that as well as part of the participation. So the submission is more important than I use the same group. I'm not sure.
Okay, I keep getting the same question, so let me clarify for the entire class. So I keep getting the question, can you mix stream in the morning stream and afternoon stream when you come to coursework assignments and participation? Yes, you can. The way I will judge the case participation is, as you will see, there are a few questions attached to the case studies, so you will have to answer these questions, submit a document that you will put on the hub, and that will be part of your participation. So I will be able to read that. Because with 260 students, there's no way everybody can participate, right? So it's not possible for me to test you just on the participation in class. It will be partly on the Word document or basically the written document you submit. Okay, so you can participate in the morning, and then your teammates can participate in the afternoon. It doesn't really matter. Okay. All right, let's move on. We've got a lot to cover. So I mentioned it's very cyclical. So this is specific to buyout. As you can see, the cycle is very different. So as I mentioned, 2016 was supposed to be a good year until Trump decided to step in. So 2017 was a pretty good year. I don't have the latest numbers yet. But what you can see is that we are far away from the craze of 2006, 2007. And that's really how a credit bubble looks like. Any other question?
What was the reason for all this doubling in volume of 5.6?
That's what I just told you about. That's the credit bubble. That's when credit is so cheap that everybody decides to do leveraged buyouts. I think my grandmother didn't do one, but she could have. It was literally so easy. Everybody was doing deals. Valuations were also stupidly high. So obviously here you have the combination of. So bear in mind these are deal values. So it's not just the debt; it's also the equity. So you have a combination of the debt quantum being very, very high, and the valuations going crazy as well. Let's imagine here that you only had half of the value in debt. Suddenly, if you put 2/3 of the value in debt, then you can pay a lot more. We'll see the impact of leverage on the RRR as well. So it's very important to understand that people are using debt because they're trying to boost their returns, and that's the reason why you want to borrow as much as possible when you do a leverage buyout. But as you can see, we are far away from the peak of 2006 and 2007, which leads me to tell you that yes, we are in a bubble. We are not in a credit bubble, though. The issue at the moment is not debt, although in China at the moment the government is a little bit over-borrowing. But when it comes to corporate debt, which is what we're looking at here, we're not nowhere near, which is surprising because when you think about it, interest rates are at an all-time low, right? So you would think that there would be plenty of opportunities to invest. But despite that, I think the banks have been reined in. They've been massively regulated, which is the reason why we have private debt fund managers that are gaining a lot of influence. Again, I go back to our guest speaker for next week, Ares Management. You will see, they will probably, I think Blair will probably show you some of the growth they have in the last few years. And it's driven by the fact that banks are no longer able to lend, and it's not to lend as freely as they did in 2006 and 2007, and therefore most of the lending is being done now by private debt fund managers like Ares. So anyway, this is really, so we talked about the fundraising. Remember the previous graph was fundraising. This is investing. So we are in the second phase. Remember, fundraising was the first stage. We're now into investing. So we are getting into structures again. This is a typical tax structure. It's going to get a little bit more complicated in the next few slides. But here I'm comparing what we call a recapitalization and a leverage buyout. What is a recap? A recapitalization is when I replace equity with debt. So as you can see here, I can borrow money, the capital comes in, and I use that money to repay some of the equity. So when public companies very often say, you know, we're gonna acquire our own capital, our own equity, that's what they do. They tend to either use the cash they have in their balance sheet, or they borrow money to buy back some of the stock. So share buyback is basically a recapitalization. A leverage buyout is the similar approach. Here, what the difference is, you have to create a new company. That new company is created by the fund manager. So if I am KKR, I create a new co. I'm targeting Boots. So Boots is my target co. And how do I do that? I borrow money. So I take loans from banks and various lenders. I take capital from my LPs, remember? They've committed the capital, I can now draw down that capital. I give them a call, or I send them an email saying I need the capital to commit to the new co that will acquire Boots. You get that capital, you acquire Target Co. And obviously, the existing shareholders of Boots, while you acquire their shares, and these shares are now going to you, and that is just the capital going to them. So you pay for their shares, and the shares are now owned by the new co. Right? So that's really the way it works. An LBO is simply a recap, but here in this case, you change the owner. That's why you have a new co. So the structure, as I explained, it requires a new co. It's a little bit more complicated than that, however. In addition to the new co, you usually have what we call the holding company, holdco. The holdco sits above the new co. The holdco exists for only one reason: to avoid paying tax. Tax should be paid by people like you and me, but not by fund managers or wealthy individuals. These people should be allowed to go offshore and hide their money away from the tax authorities. This is what the holdco is all about. I put my holdco in an offshore center: Jersey, British Virgin Islands, Cayman Islands. Luxembourg is pretty good, although they charge 3%, which is pretty steep. Right? So I pay 35% on my income, but most of these funds or LBOs do not pay anything. So here I've given you an example of a deal that took place a while back now. But Club Med is a French company. They basically run, if you don't know, they run resorts all over the world, and they were the subject of a takeover. They were listed, so they were delisted, and they were delisted by a Chinese company called Fosun. However, one of the other bidders was Andrea Bonomi, who is actually a very wealthy individual. And in order to bid for Club Med, he created a new co, which he called Global Resorts. Okay, so Global Resorts is the new co that Bonomi created in order to go and acquire Club Med. Well, Fosun did the same. Obviously, they created their own new co, and that's really how you go after the target co. Now, under the new co, you will have what we call the opcos, operating companies. So Club Med, as I mentioned, is going to be the parent company, the headquarters. That's what the new co will buy. And underneath, obviously, they own loads and loads of subsidiaries. You've got Club Med in every country in the world, and every country, so Club Med Tunisia, Club Med France, Club Med Spain, and underneath you will have all the separate resorts where tourists go and have a nice holiday. So the opcos are where the cash is being created. And that's important. The cash is being created locally, okay, in each of the countries. But as you probably understand, if I am generating cash in Tunisia, in France, and Spain, I'm going to be taxed in these countries. So there needs to be a structure that allows me not to pay tax. Tax is cash leakage. If I am trying to maximize cash repayment of my debt, I cannot have cash leakage. I can't afford it. I must not pay any tax to these countries. So you have, obviously, countries have agreements. They have tax agreements where they don't double tax companies everywhere in the world. And so you make sure that none of the tax is paid by the opcos. The cash is filling up this transaction structure. So it needs to go all the way to the holdco or the newco, and it's going to be used, so the cash moves up from the opco to these companies, and it's going to be used to repay the interest or the principal of the debt. And then if there's some left, it's going to go all the way to the holdco, and the holdco will be where the GP, the fund manager, has been setting up all its equity. And the holdco, as I mentioned before, is in the tax haven.
So for each fund, there's only one holdco.
Absolutely.
And many other holdcos or targets.
No, sorry. For every fund, there is a holdco that is being created for each transaction.
For each transaction.
Yeah, absolutely.
Why can't they just use one for every transaction?
Well, imagine that one transaction doesn't go well. You're impacting all the others.
Okay.
You could bring down the entire structure by just one deal. So when Terraform did EMI, 30% of its equity was invested in EMI. EMI went bankrupt. They could have bankrupted the rest of the portfolio if they had done that. So they have to be independent. Each deal requires a newco and an holdco. They could be in the same tax haven, by the way, right? Most of them in Europe are in what we call Luxco, Luxembourg company. So Luxembourg is a very good tax haven for LBOs in Europe. I will explain later on, the difference between equity, alt, press, subordinate stock. But just bear in mind, this is just the equity portion of the fund manager. The senior debt and mezzanine comes from debt providers, from private debt fund managers, banks, or mezzanine fund managers, and it sits below the holdco. Now that's quite important because we're going to talk about the seniority. The most senior in a structure, the instrument, the closer it is to the cash generative operating companies, because they are the first ones to be repaid. By seniority, I mean the ones that have first priority right on the assets. If I provide senior debt, that debt has first priority on the assets. After that, it's called junior debt or subordinated debt. Mezzanine is a type of subordinated debt. It will have second or third priority on the assets. And the equity holders are the last ones standing. So if there is anything left, it goes to the equity. That's why the capital gains goes to the equity. If there is no capital gain, they get nothing. So again, the cash moves up from the opcos up the structure, and it repays, based on the repayment requirement of the debt and the various instruments. So let's talk about each of the instruments. I'm going to start with the equity, which is the portion that is invested by the fund manager. There are various types of equities. The most common ones, but the smaller proportion of the equity structure is what we call ordinary shares in this country. If you're American, it's called common stock. Okay. So ordinary shares are the ones that receive the dividends, assuming a dividend is being distributed. They receive a portion of the assets on winding up after payment to all the creditors sitting before them. So the ordinary shares, the ordinary shareholders are subordinated to everybody else in the structure. And the benefit of the ordinary shareholders is that they can vote during the shareholder general meeting. Not all the others can do that, right? So that's really one of the key benefits of having common stock or ordinary shares. Everybody's aware of what article associations are? If you're American, it's called Certificate of Incorporation. If you're French, it's called the Statute of the company. So every company can only exist if it has a document, a legal document, that is called the Article of Association in this country. It's the foundation document of the business. So I don't know if you have a legal class, you have a class on corporate law, but you can't have a company if you don't have a document that proves that that company exists. And these articles of association that need to be filed with, or in this country, Companies House. There's a register in every country where every company that exists has to register its articles of association. That everybody in the country or in the world can read. And so we'll talk about what the articles include. Preference shares. So the preference shares are slightly ahead of the ordinary shares. In America, it's called preferred stock. So they rank ahead of the others in terms of repayment of capital, but they are behind all the other creditors. They carry the right of a specified fixed dividend. Their dividend gets paid before the dividend to the ordinary shareholders. They might not have a right, by the way, of fixed dividend. Okay, it's not compulsory, but if they have one, it tends to be fixed, and it will have to rank ahead of the odds. It is usually redeemable at the company's discretion. So a company might decide, you know what, I don't want to have the preferred equity anymore. I'll just pay it back. So that's what we do the recap. Remember, we do a recap. I mentioned to you, you can borrow money, you can use some of the cash to buy back some of your shares. Typically, the preferred shares are the first ones to be bought back. And they can be convertible into warrants, which is another way of getting rid of a complex structure. So if you've had prefs that you wanted to distribute at different stages of your life of the company, you might decide to convert them into warrants eventually, just to simplify your capital structure. We will see that prefs are very common in venture capital. And finally, you have a shareholder loan. And I put the note here because every year, I guess students get confused. Yes, the shareholder loan is equity. Although it's called a loan, it sits in the equity section of the balance sheet. Everybody is aware of what the balance sheet is, I'm hoping. I know some of you don't do accounting, so you have different streams of the master's degrees, but no, the balance sheet has an equity section. The shareholder loan sits in the equity section. So it's very much an equity instrument, even though it is called a loan note.
But if you do a rating agency presentation, most agencies like Moody's will not accept that as an equity instrument, right, when determining the rating.
But they are rating agencies, right? They're not accountants. But I can guarantee you this is equity. And the reason why it's equity is because it will sit behind all the other loans, and it will be provided by the equity investors. So the fund manager is simply, using that as one of these instruments. Now the reason why they use it is simply, again, for what I've mentioned before, cash leakage. You don't want to pay tax, and we haven't done the LBO model yet, but you will see that when you realize that you have some spare profits every year, you really don't want these profits to be taxed, because that's just wrong use of cash. You're paying the government, you're going to have to pay for infrastructure, roads, education of people. That's not what you're here for. You're here to make money for yourself. So this is what this is about. If you charge interest on your equity, shareholder loan, you are taking away that profit from the tax authorities, and instead you're using that profit to pay back interest for you, the fund manager. That's why it sits here. So that's an instrument that's been very cleverly created in order to avoid cash leakage to the tax authorities. If you're not able to raise, and the reason why it exists is because you might not be able to get enough debt from the market. The banks might be nervous. They might think, well, because of actually the point you made on rating agencies might say, actually, we're going to give BBB rating on that stock. Well, if you do that, or on that bond, I should say, if you do that, then this is junk bond status. Then obviously that damages the ability of raising more debt, because the banks or the fund managers will be nervous about lending you money. So one way to do that is that you, the fund manager, the private equity fund manager, decide, okay, well, if you don't want to give me debt, I'm going to create my own debt. That's my shareholder loan. Okay? But it's very much equity. And again, the benefit is simply that it is tax deductible. Whereas here, the dividend isn't. So my dividend is paid after I've paid my taxes. If I don't want tax authorities to get any cash at all, and that's really the objective of every LBO, if you don't want tax leakage, you create a shareholder loan. I mentioned here the warrants. And we're going to talk about that a lot. Warrants are simply an option that you give to, typically, in the case of an LBO, you give it to your junior lender. So a mezzanine provider might say, okay, I'll provide you the mezzanine, I get my interest, but if me, the fund manager, I don't want your interest because I find it too high. Typically on mezzanine, you could be paying 10, 12% interest every year on the principal. One way to reduce that is by giving a warrant to your mezzanine holders. And a warrant gives them a share of the equity upside. So they might be willing to say, okay, I'll charge you only 9%, and in exchange I'll take a 1 or 2% warrant. Okay? That's one way to reduce the cost of the debt. Some more equity terms. We will do a ratchet example. So there are different types of ratchets. The only point that you have to remember with ratchet is a mechanism to increase the allocation of, in this case, profits to the equity holders. But when we talk about the margin ratchet, when we talk about that, when we talk about the leverage, the loans, then in that case it's simply reducing the cost of the debt when you're able to meet some financial ratios. But a ratchet is simply a mechanism to alter the apportionment of gains. So we will do an equity ratchet mechanism exercise. I think we'll do it during VC block. We'll have more time. In this country, there's what we call entrepreneurs relief. It doesn't exist in the US, but here, what's important is that if you are a management team, no, we talk about management buyout, management buy-in. So if you're a manager running a portfolio company, any capital gains you will generate will only be taxed at 10% compared to 28% here for capital gain tax in this country. So it's a great way to motivate management teams on the equity side. Shareholders agreement, we'll visit that a little bit later when we talk about the legal documents next week. But here it simply defines is all different shareholders you have. So the fund manager, as the key buyer of the company, clearly is going to be the 90-95% shareholder in the business, but it invests alongside management, remember? So whether it's a management buy-in or management buyout, you have a management team running the portfolio company, and you have the fund manager sitting above owning the business. While 95% of the equity might be owned by the fund manager, 5% might be owned by the management team. Okay? So you need a shareholder agreement to make sure that they all understand what their roles, their respective roles are. And some of the terms that you might not understand here are tag-along and drag-along rights. We'll revisit them again next week, sorry. Or next year if you want. But what's important to bear in mind is tag-along is simply the right that you have as a shareholder to tag along in the case of a sale of the business. A drag-along is a right for you, a shareholder, to drag all the other shareholders when you want to sell the business. Imagine that I am a 90% shareholder and the management team has 10% of the business. If I don't have a drag along, I might get an offer for my 90%, but if I can force them to sell, the buyer might say, no, I want 100% of business or nothing. So a drag along right gives me the right to force the management team to sell its stake alongside mine. And similarly, a tag along right, the management team might say, well, I don't really like the buyer, I don't want to be forced to stay on board, therefore I have the right to tag along with you, the majority shareholder. If you have 90% and you're selling to that party, me, the 10% shareholder, have the tag along right, so I can sell together. NV ratio. Now this is not used very often, but it does exist, so that's why I teach it. The NV ratio is just it's used as a mechanism to determine what proportion of the business you want to allocate to the management team. Now typically, as I explained, the fund manager, the GP, has control of the company. Right? It can acquire 60, 70, 80, 90% of the business. Well, then you have a management team that acquires the rest. But it doesn't mean that the management team is going to have to, if it owns 10% of the company, it doesn't mean it's going to have to put 10% of the equity. Typically, if you are trying to buy a business worth $1 billion, or $1 billion, if you are putting, say, 10% of equity, that means 100 million. If you want 10% to go to the management team might not have 10 million to invest, right? So they might just put 5 million, but they still get 10%. So the ND ratio will determine that relationship between how much the private equity firm is investing compared to what stake it has in the business, divided by how much the management team invests and what stake it has in the business. Now the ND ratio is a way to motivate the management team. To tell them, we give you more than what you should be entitled to if you were going to do it in proportions. You're not putting 10% of the equity, but you are getting 10% of the company. Typically, obviously the ND ratio can vary. It depends on how much leverage of bargaining power the management team has. But the maximum we will see is 10, right? It's very rare to be anywhere near that. But as a general rule, you will never agree to have an ND ratio as a fund manager, as an investor. You will never agree to have more than 10%. More than 10, sorry, as a ratio. So you will want to invest obviously more because you want the management team to get some kind of incentive. However, you're not going to be giving them unlimited upside. Okay, some more on the equity side. So the equity side, as I mentioned to you, the management equity will be a small amount. However, you might get a big stake in the business. If you are trying to acquire a business that already has a management team in place, in the case of a secondary buyout, as I explained to you, you might be buying a business that already had a leveraged buyout taking place. You're buying the business with its management team. The management team in place, say, has 10% of the proceeds. Well, you don't want them to become multimillionaires because their motivation will be pretty low. Most people, once they've got 10 million in the bank, they don't have the same priority. So to make sure they keep, they're still keen, still eager to go to work, you might force them to reinvest 90, 80, 70% of the proceeds. To make sure that they make maybe 1 million so they can buy themselves a nice house, but they don't have 10 million in the bank. Okay? So that's what we say, they expect to roll over. Rolling over means you roll over some of the proceeds you've generated. And obviously the other equity holder is the PE investor, the fund manager that is investing most of the money. And that money, obviously, remember, comes from LPs, so it's the capital commitment that is being drawn down and invested as equity in the business, in the target. I've mentioned that the loan interest is that notable while dividends are not, and that's the reason why you have shareholder loan notes, irrespective of what the rating agencies are saying. It's very much equity. The only trick is that because you don't want profits to be taxed, you decide to create more debt instruments in order to charge tax deductible interest. All right, let me ask you a question then. Okay, who says it's A? Raise your hand. One. Who says it's B? 2 people, 3, 4, 5, 6 people, 7, 8. Who says it's C? Who says it's D? 1, 2, 3, 4, 5, 6, 7, 8. Wow, we've got a draw. Wow. We have a draw. Yeah, look at this. Okay, so it's clearly not the first one because no one chose it. So I'm assuming that can't be right. Yeah. Okay, so it's not A then. Can it be C? Oh, it's not C. Is it B? Well, I think you're right. It's both of them. So, the financial risk, I know, it's very tricky. Two answers are right. It's ridiculous. What kind of class is this? Okay, the financial risk relates to leverage. Okay, you're going to borrow money, and there are two types of risk. You have business risk, and you have financial risk. The business risk is anything that is related to any company anywhere in the world. So that includes market risk, it includes operating risk, it includes any risk that is related to that business. It could be sector related, it could be a regulatory risk. So any company faces a business risk. The financial risk is related to the capital structure of the business. So some companies have no debt, therefore they have no financial risk, because they have no risk of not being able to repay the interest. So when I look at B, if I'm not able to repay my debt, and therefore the interest payments, that means I'm obviously facing financial risk. And similarly here, if I'm highly leveraged, then I have financial risk because there's debt in my structure. Okay, so anything that is related to the capital structure, including some debt, then there will be financial risk. If I have no debt, I don't have financial risk. Okay. Let's do leverage then. Since we talk about the equity, as I mentioned to you, a big portion of LBOs is about leverage. So we talk about the equity side, now we talk about the debt. The debt side is the technical part. If you thought there was a lot of jargon until now, you haven't seen anything yet. So debt is complex. And that's the reason why so many companies go bankrupt, because most people underestimate the risk of leverage. So debt is secured or unsecured. What we mean by secured is we mean that we use some of the assets as security, as guarantee. Okay, so if you're raising a mortgage, the mortgage will be secured on your house. If you can't repay the mortgage, the bank will take you out and your furniture and tell you that you belong to the street because the house now belongs to them. That's what happened during the 2009 subprime bubble. Okay, a lot of people who couldn't afford the mortgage ended up in the street. So houses get repossessed, just like some lenders repossess a leveraged business. At some point, the lenders will use the security to say, I own these assets because I have the debt that you can't repay. Subordination is when, and I talked about that a little bit, but just to clarify, some debt is more secure than others. If I have first priority on the assets, I am the senior debt. Seniority indicates that I have security. If I don't have any security, or if I have second, third, fourth priority on the assets, that means if something remains of these assets when they are liquidated, I might have something being paid back to me, then I am subordinated. I'm subordinated to the senior, to the secured lenders. The information covenants are commitments that are made by the borrower to provide information to the lender. If I am going to borrow money for my mortgage, the bank is going to say, okay, what's your annual salary? How much money do you have in the bank? Do you have any net saver? Are you a borrower already? Do you get a bonus every year? Is your spouse also earning some money? In which case, we look at the two combined. So all these things really are taken into account. This is what the information is all about. So similarly, if I am a company borrowing money, every quarter or every month or every year, I will provide some information to the lenders, to reassure them that I am meeting my business plan, to reassure them that I have the ability to continue to service my debt. So that information really is used by the banks or the lenders to monitor the business. In addition to information, I have financial covenants. These are very, very important. They are ratios that I have to meet on a quarterly basis. And we will go through some examples. These ratios give me confidence that I am able to service my debt. And every time I miss one of the ratios, I get in trouble. I have to sit down with the lenders and I have to renegotiate the terms of the loan. I might have to request to recalculate the ratio, in which case they might ask for a consent fee. Remember, banks are just like fund managers. They make money on fees. So whenever you borrow money, you should know that the bank will charge you fees on a regular basis. So in this case, we will go through some of the examples of the financial covenants, but they are simply corporate ratios. There are 4 or 5 key ones that we will discuss in a little while. Then you have the headroom. The headroom is a buffer above the financial covenants. So these ratios, if you come within 15, 20, 25% of the ratio, you get into this danger territory. That headroom is here for a reason. It's a warning signal. It tells the lender that company is getting stretched a little bit. It's getting very close to the ratios. And that's when you start, in principle, discussing with your lenders, whether or not this is just a blip, or whether your company is starting to get a little bit, it could be getting into a cycle, there could be a new competitor coming in, therefore it's impacting your pricing, therefore it's impacting your profits. All these things are being discussed with the lenders to make sure that they are aware of what is going on, what explains why you breached the headroom. And obviously, the headroom varies along the cycle, right? So, because this is something that the borrower is not very keen on, if I'm a private firm, I don't like headrooms because I give right to the lender. I don't want to give right to the lender. I want to be in control. I don't want to have to, give them clarifications on a regular basis as to why my business is breaching the headroom. And so, when I'm in a boom, I'm going to negotiate very hard with the lender, tell them I only give you 10% headroom. I don't want to have to tell you as soon as I get within 25%. But obviously, when you're in a credit crunch, then the lenders have a lot more power and say, I require to be notified if you come within 25%, for example, of your financial ratio. Okay, so that headroom varies across the cycle. The key terminology, again, continues, some more jargon. We have the intercreditor agreement. You have loads and loads and loads of lenders. You're not borrowing money from just one party. If I am doing a leverage buyout, in the case of TXU, which was the biggest buyout ever, it's also the biggest bankrupt buyout ever. That was done by KKR, $40 billion, went bankrupt 3 years ago. Well, you had 500 lenders. So you borrowed, I think they borrowed something like 35 billion. 35 billion, as you can imagine, there's no bank out there that has 35 billion to lend you. So they had to go through hundreds of different small lenders and big ones and borrow money to them. Not to mention that obviously they had originally underwriters, as we call them, so large banks that underwrote the full transaction, but then they syndicated all the loans in small tranches. So they slice down all the debt, and eventually you end up with hundreds of lenders. So these lenders have to be obviously tied to some legal agreement. That's what the intercreditor agreement is about. It determines who's got security, who doesn't have security, who is getting fourth or fifth security, priority on security. Which one is unsecure? All this, it will be in the agreement. Who's got the right to vote, and on what point. So this is there. Standstill is another agreement that, as you can see, is between the company, so the borrower, and the lenders. And then it determines whether the lenders agree or not to enforce action. So again, imagine you are in default, the lenders can decide, you know what, we're not going to do anything about it. Yeah, we have the right if we want to, but we decided it's no big deal, so we will not act. So that's what a standstill is about. It gives the right to the lenders to say, okay, it's not that important, we're not going to do anything about it. The term, we're going to go through the different terms for each of the various types of loans, but they can vary. Typically a tranche A, we'll talk about what a tranche A is, has a 7-year term. Sometimes I've seen some of them only 6 years, but typically that gives you the term, again, as part of the agreement. Bullet repayment. A bullet repayment is when you pay back the full amount of the debt at the date of maturity or whenever you sell the business. So you don't amortize the debt, you don't pay it back during the life of the LBO, you only pay it back in full at the end of the LBO or whenever the debt instrument matures. And then you have the coupon. Now the coupon is only for bonds. The coupon is simply the interest. So if you say I'm raising an 8% bond, that's the coupon we're talking about. It's different from the interest. We'll explain why in a minute. Okay, so let's talk about the various debts. We'll talk about senior, we'll talk about junior, so I will go through each of them in detail. Okay, there are loads of different debts. So here we have, typically the one that is secured is what we call the senior debt. It's also called term loans. Term loans because they have a set term, and that's really the way it was set up originally. So here we have the A tranche, and the A tranche, I'm going to do, if you can't read, don't be surprised, I've got an appalling handwriting. But I'm doing my best. So I'm going to have maturity, I'm going to have margin, and I'm going to have bullet or repayment. So for the A tranche, typically it's a 7-year term loan. So that means that if I raise money this year, I will, it will run up until 7 years from now. The margin, typically, that's the margin of a what? Any idea when I say margin, what I mean? Say again? Margin on the assets? No. It's margin on the rate. What rate can it be? LIBOR. So let's say here I've got a 3.5% margin on LIBOR. I'm hoping you've heard of the LIBOR scandal, the rigging scandal. The reason why it's so important is because every debt everywhere in the world, every mortgage, every instrument that has some margin has got a margin on either LIBOR or Euribor. And so if you can read that interest, it's fantastic, isn't it? You can make some illegal gains. Obviously, you don't want to get caught, right? That's my recommendation. So if you're going to read an instrument that everybody in the world is using, make sure you don't get caught. But if you can add even 1 basis point, i.e. 0.01%, you can, on a large volume, you can make millions, sometimes tens or hundreds of millions. So this is why the LIBOR scandal was important, is because if I'm at, I think UBS and Barclays, were obviously quite well known for rigging, but everybody did it. It was normal. It was market standard, as they all. That was their defense in court. It was market standard. Everybody did it. So if you can read that, obviously it will impact how much I pay on my interest on my LBO, because my margin is on top of that rate, and that rate is being rigged. So let's say it's 350 here. At the moment, it's probably what it is. So being paid a margin of 350 on top of LIBOR. That's my A tranche, and then it's an amortization. So I amortize my debt. What do I mean by amortizing? That means I'm going to repay it during the life of the instrument. So every year I will repay a percentage of the principal in addition to the interest. You know, obviously I have to pay the interest, and on top of that I have to pay the principal. The B tranche, so as you can see, there's a B here, is 8 years. It's typically 1 year on top of the A. So if the A is 6 years, my B tranche would be 7. The margin typically is 50 basis points on top of my A. So if my A is at 225, 275 would be the margin I have on my B. Another difference here is that the B tranche is a bullet debt, bullet repayment. That means I don't pay anything during the life of the instrument. I pay all of it at the end of the life and maturity of the instrument. Now I have a C tranche. Guess what? It's 1 more year on top of the B, 9 years. And yes, it's 50 basis points on top of the B. And that one is also bullet. So these are typically the instruments you have in the senior debt. These are term loans, as we call them. And the A is always amortizable. The B's and C's are always bullet. So this is what you have senior debt. And senior debt is the main proportion of the full debt you have in your business. So it could be 60%, 2/3 of your debt package will be in the shape of senior loans. Now after that, as you can see, we have what we call a second lien note. So the second lien refers to the fact that it's subordinated to the senior note. So the senior debt is first lien, and second lien means that it will have, although it will be secured, it will have second priority on the assets in case of a winding up. And your second lien, so sometimes it can be called a D tranche. And so the D tranche is going to be 6 months more or longer in terms of maturity than the C tranche. It's always 6 months more than the longer dated senior loan. So if I only have 2 tranches, A and B, for my senior loan, then my second lien will be 6 months longer than the B. Here I've assumed there's a C, but there might not be a C. Sometimes you only have an A. Okay? Just depends what you manage to negotiate with your lenders. So 9.5, and then guess what? It will be 50 basis points more expensive than the C, or than the lowest tranche of the senior. So if I only have a B at 4%, I might have 4.5% here for my D, for my second lien. And finally, this is a bullet. The tranche A is the only one that is amortized. There is no other instrument that can be amortized when it comes to debt. All the others are bullet. And again, amortized, you have to negotiate an amortizable schedule, and you negotiate that with the lenders at the outset. Okay, so we talk about senior debt, we talk about second lien. We have other senior instruments that we call a revolving credit facility or a working capital facility, same thing. It's also called a revolver. Please, when you look at bullet and revolver, don't assume that we are dangerous people. Although I have to say sometimes we do end up killing a company, but that's a different story. But this is just the terms that are being used, right? So when you hear the revolver, they're referring to the revolving credit facility. And these are instruments that are always aligned to tranche A. So what that means is that my revolving credit facility, RCF, is going to be 7 year long. It's going to have the margin of 350. However, it won't be amortized because the whole point of these facilities is that they are available for drawdown whenever you need them. So for those of you who are not in the accounting class, let me explain what a working capital facility is all about. When a business trades, it has cash requirements. If a business is very seasonal, it might not have the same requirements for this cash throughout, equally throughout the year. If you are a chocolate manufacturer, you will have to spend a lot more in the run-up to Christmas and the run-up to Easter than you will have in the summer. So in the summer, you might have no working capital need at all because you're more or less doing nothing. Nobody's buying chocolates. But when everybody is trying to buy chocolate at the same time, like for Christmas or Easter, you need to ramp up your business. That means you need more cash. You might not have that cash available in the business, in which case you will draw down on your working capital facility. So you will draw down that facility, say in October, November, December, and then you will pay it back in the summer when you have no cash need. Which is why you don't amortize, you simply draw down and repay as and when needed. However, you have that facility available only for 7 years. If you don't need it, you might not draw it down at all, okay? Typically you have one because you just never know whether there's going to be a need for cash at some point. Yes?
Does the bullet mean you only pay the principal at the end of the life, but interest during the...
In the case here, yes, absolutely. We're going to see that it's different for junior debt, but you're right. Here, when I say bullet, I'm talking about the principal. The interest is paid during the life of the loan.
You can have a Pixable, couldn't you?
That's a junior. Don't go ahead. This is the next slide. So for senior, here we're talking about bullet principal and interest paid as and when on a quarterly basis. Okay? We'll talk about PIK in a second. Okay, so this was working capital facility. The CapEx facility is a different facility. Again, it's available to be drawn down if and when needed. It's got the same terms as the A, 7 years and the same margin. However, again, it's not amortized. It's drawn down when you need it. Why would you have a CapEx facility? Well, you might be in a sector that has a need for a new factory every 5 years. Intel, the biggest microchip manufacturer in the world, spends typically $1 billion to $2 billion every time it builds a new factory. It doesn't build one every year, but every 3 or 4 or 5 years, when capacity is maxed in its existing facilities, it needs to build a new factory. Well, it will usually use a capex facility to do that because it's you don't have 1 billion lying around, although they might, because it's Intel, but in many industries you don't, right? If you don't have the cash, so you draw down on the facility, on the capex facility. So it's for capital expenditures that are needed, occasionally. And finally, you have another facility called acquisition facility that you draw down on when you want to do acquisitions. Again, 7 years. It's available for 7 years, that facility. It's on the same margin. Once drawn down, it's on the same margin as the A, the tranche A. But it's not amortizable. It's drawn down and repaid whenever an amount is needed. So if you acquire a business, you just need $500 million to buy it. You will draw down the acquisition facility, and then if you generate enough cash, you create synergies. Within 2 years, you generated enough cash to repay. You repay that acquisition facility. You only pay margins if you draw it down. If you don't draw it down, you don't pay anything, except because this is banking, and you remember we talked about that. You need to be paying fees. You pay what we call an arrangement fee. So an arrangement fee, typically between 1.5% and 3%, depending on the facility we're talking about, you will pay to the bank for the full principal. So if say you want an acquisition facility of 500 million, you will pay at the outset 2%, say, arrangement fee on that facility. So you've got 10 million going to the bank, even though you might never draw down that facility. Okay? Any question on senior debt? No? Okay. So just again, this is accounting. So I figured that I've added this here because sometimes I get some questions that tell me that people don't quite understand the whole point of some of these. This is how a balance sheet looks like. So you have assets on one side, debit side, and you have obviously liabilities and equity on the credit side. And I like to show this graph because people don't always understand. Equity is a liability. That's the reason why it's on this side. Okay, you owe that money. Whether you owe it to a bank, a lender, or to your equity or shareholders, you still owe it. So therefore, it's a debt. If you owe it, it's on that side. And assets obviously are on the other side. They are, the gains you accumulate. They are the assets you buy. And if you have some cash, the cash sits here. But if you have no cash and overdraft, well, typically you finance the overdraft with what we call the revolver credit, right? The revolving credit facility I just told you about is sitting here. It's when you don't have, if you're a negative cash position, you need that RCF, that credit facility. Okay. And typically, when you do an LBO, you do it on a cash-free, debt-free basis. So you buy the business, and you have to completely refinance it. So even though you might have some debt in place, you need to refinance that debt with fresh debt, which means that the banks get paid another fee, arrangement fee. Every time you have to change something, the banks will charge you more fees. All right, junior debt. So there are 3 types of junior debt. Let's talk about the high yield debt first. Bond. So hopefully, I don't know if you read, I recommend you do read, and I'm not talking about Facebook pages. I'm talking about books on the subject, but junk bond, the big junk bond mania of the 1980s. We don't want to talk junk now, but that's basically what it is. High yield bonds are junk bonds. So high yield bonds are simply debt instruments that are of a very high yield, meaning high coupon. Very, very expensive debt. And so, as I mentioned here, typically the coupon is between 8-10%. Depends how much bargaining power you have with your lenders. They are usually warrantless. Remember, we talked about the warrants. So a bond usually doesn't have any right to the equity upside. It's got a fixed coupon, very expensive, and that's basically all it is. It's non-callable. What does that mean?
You cannot redeem it before.
Yeah.
You have to pay throughout the whole period.
That's right. Now, typically, what you will have you will raise a bond, and the bond could be if you raise a bond that is 8 year non-4, what I mean is that it's an 8 year, that's the maturity of the bond, okay? So that means it's maturity repayable after 8 years, and it's not redeemable for the first 4. Okay, so it doesn't mean, when I say non-callable, it doesn't mean it's non-callable for the full period of the bond. It might be that you have, half of the life of the bond. That means you can't redeem it. You can't pay it back. Now, in practice, we will see that you can pay it back. But obviously, what does that mean if you pay it back early? Yeah, you pay a penalty, you pay a fee. You have to. This is the banks. So, cannot pay a bit early. You have what we call the make-whole payment. So if doing that, non-4, I told you if you can't pay it back in the first 4 years, but you do want to pay it back, and one reason why you might want to pay it back is because you've decided to sell the business. Remember, if you sell the business, you're the fund manager, you sell your company, and you have to refinance everything. The bond cannot stay with the business, it has to be refinanced. Therefore, the bondholders will require a penalty, and that penalty is called the make-whole payment. And it can be very, very high. Now, a few years ago, I sold a business, and we sold it before we were allowed to redeem the bond. and we ended up paying on the business. I'm trying to remember the size of the bond, but I can't remember. It was maybe $150 million, and we ended up paying $20 million make-whole payment. Very expensive. So you don't want to do it unless you have to. But we had a good buyer, so we decided, okay, we'll just accept the penalty. But it was very expensive. So if you can avoid it, you don't pay it back before you're allowed to. A bond is listed. Okay? And that's the reason why it's rated. So you talked about the rating agencies. Rating agencies rate the bonds. When you say, oh, they rate the debt, well, they can only rate the debt that is listed, right? Because they don't have information on the private debt. So they rate the bonds, the listed bonds. And they have to. You can't have a bond listed unless it is rated. It's registered. So in the US, it's registered by the ICC. It's unsecured, which means we go back to the subordinated. So it's subordinated to the junior debt, to the senior debt. Sorry, it's part of the junior debt. It has a minimum deal size because obviously, if it's listed, it will incur a lot of cost, right? It's expensive to list an instrument on any market, whether it's a bond exchange or a stock exchange. It incurs a lot of cost. So there is a minimum size, also because you want to provide liquidity. So the size is for two reasons. First of all, you incur fees. Number two, you need to provide liquidity to the bondholders. If the tickets are too small, if you raise only 10 million, you might not be able to sell. Right? So you're holding a bond and nobody wants to buy it. So to provide enough liquidity, there's a minimum size. That means bonds are typically for the larger deals, right? The deals of 1 billion plus, because the bond will be 10% of the structure. So typically you're looking at large LBOs use bonds, smaller ones don't. Now you can have zero coupon bonds. I'm sure you've heard of them, even if you don't have a class on this. But zero coupon bonds are simply discounted bonds. So the way it works is that you issue them at a discount, and then you repay them at par. So again, an example would be, I'm raising an 100 million bond, but you only pay me 80 million. So you pay me 80 million, I give you 0%, you don't earn anything. However, on the way out, I would pay you 100 million. Me, the borrower. So you pay me 80 million, you're the lender, and I pay you back 100 million whenever the bond matures or whenever I decide to sell the business. Okay?
Excuse me.
Yes, sorry.
Why the liquidity will improve by the minimum deal size? Because the lower the size, the higher the liquidity.
Again?
The minimum deal size,
Yeah.
in my understanding, is the lower the deal size, the higher the liquidity, because you can trade with function.
No, I mean, if I only have 10 million, by definition, in smaller, let's talk about stocks, right? Let's ignore bonds for a second. If I have a stock, is it easier for me to trade G stock or a stock of 100 million? There'd be more liquidity, right? There'd be more shares. By definition, I can buy one share of G, and I know loads and loads of, maybe 10 million of them are going to be traded in one day. If I own one share of a small business, it will have fewer shares, almost by definition. Therefore, there will be less liquidity. There will be fewer buyers on the other side whenever I want to sell my stake. It's the same for any instrument, and bonds the same. If I have a bond of 10 billion, well, on $10 billion, if I own $1 million, it'd be much easier to sell my 1 million than if I have 1 million of 100 million. I've got 1% of one of them compared to 0.1% of the other, 0.01% of the other. No? You understand? No?
No, I will elaborate.
Okay, we can do it. Any other question? Okay, second type of junior debt, mezzanine. I talked about that a little bit earlier. So the mezzanine is different from the bond. First of all, it's not listed, so it's private debt. And again, it falls between the senior debt and the equity, just like the bond. it can be warranted, and I explained that as an example when I talked about the warrants. So mezzanine is expensive. It can be more expensive than bond. Very often I've seen mezzanine being much more expensive than bond. It can go up to 12%, sometimes even higher. So one way to make them cheaper is to allocate a bit of equity upside to the mezzanine holders. So we give them a warrant. Okay, so it can be warranted. It doesn't have to be, but it can be. Whereas, as I told you, the bonds cannot be. Convertible means they have an equity kicker as well. So I can convert my mezzanine. I can give the option for the mezzanine holders to convert them into equity, in which case they will have the equity kicker, as we call it. We talked about the margin on LIBOR, Euribor. So again, look at that. You know, these margins are huge. So if I've got a LIBOR of, at the moment, I think it's around, maybe 1%, maybe a bit less, but I add this on top of it. It's an expensive debt. Bullet repayment. So it's very similar to the B's and C's of the senior loan. Remember, the tranche B and C are all bullet. Same thing here. So my principal is bullet. And so here I'm including a different type of repayment. So the repayment of the interest, remember I told you the bullet, as you rightly asked, the bullet was only the principal. The interest on the A, B, and C is repaid during the life of the loan. When it comes to mezzanine, I typically have a hybrid type. So I have one part of the interest that is repayment, cash repayment. We call it cash, it's the cash portion of the interest. And then there is an element that is called PIK, payment in kind. So the payment in kind, clearly, by definition, is non-cash. So you don't pay any cash for it. But you have to pay it at some point. And you pay it at the end of the life of the instrument, or whenever you sell the company and you have to refinance, right? So whenever there is a trigger. So what is payment in kind? Why is it called payment in kind? It's because you don't actually pay, it's not paid in interest, it's paid in additional instruments. So you're adding to the principal. So if I take, we're going to stick to 100 million, so one number. If I do a mezzanine, if I raise a mezzanine of 100 million, and I have, say, 10% on interest, okay? Sorry. So that's, interest meaning margin plus LIBOR, right? So I've got my holding 10%. So that means, say, 5% is going to be cash, and 5% is going to be PIK. Okay? That's per annum, by the way. So let's say now I hold it for 5 years. That means that at the end of the life, when I come out at 5 years, although it's typically a 10-year term, after 5 years I managed to sell the business, meaning I have to refinance it, I have to repay it. 5% of 100 million gives me 5 million, times 5 years means 25. So I have to repay $125 million at the end of the life. Does that make sense? Now if I was going to full year, if I was going to 10 years, I would have 5 million times 10, I would have to repay 150 million, right? After 10 years. So it's a payment in kind. I'm basically paying back as part of the principal another element, which is that accruing PIK element. So in this case, part of the interest is bullet. So for the senior, the bullet only refers to the principal, but in the case of a PIK, you are also bulleting the part of the interest. So now we have another element to talk about, the rate. It can be floating or fixed. So when I have no warrant on my mezz, I have a floating rate, and when it's warranted, I have a fixed rate. So the floating rate obviously simply means it's a margin on LIBOR or Euribor. Okay, that's why it's floating, because your LIBOR and Euribor gets rigged on a regular basis. Whereas the fixed rate means that it's not a margin, it's a fixed rate, it's an interest rate. Doesn't change. Now, obviously, bankers don't like it when they lend you money and you pay too early, because they want you to keep paying them some nice interest, and therefore if you prepay, you will get penalized on the mezzanine as well, but not as much, nowhere near as much as the bond. Okay? So you have a small penalty, but it's just a percentage, negotiable by the way with the lenders. But you're not going to be. So I say first 3 years. Obviously, that part is standard. However, it can be it can be something else. It can be first 2 years or first 4 years, whatever you negotiate with the lenders. But typically, in the first 3 years, if you prepay, then you get penalized, and after 3 years, you get away with it. Just simply because the lenders don't like it when you repay, because they have to put their capital somewhere else, right? Once you prepay, and say, oh God, I've got to find another borrower. So they don't like that, to penalize you, they make you pay for it. And finally, what's interesting is that unlike the bond holders, mezzanine holders can have a board seat. Typically, it's an observer seat. I've seen a lot of people when I've been on the board where mezzanine holders have the right to observe, so they can't vote. They can speak, but we tend to ignore them. But they're allowed to sit on the board, so they can see the mechanism, they can see the decision-making process, and they feel a bit more comfortable. Okay? Let's move on. All right, we're still on junior debt. One more instrument, the PIK note. So I think you probably know what's happening here. Unlike the mezz, here the entire interest is PIK. So typically it's unsecured. I mean, it's really, we're talking about junior, bottom, really, there's nothing here. Even if you had some kind of priority on the asset, you'd be 4th or 5th ranking, so you never see any of it. So most of it is unsecured. It can be warranted, just like the mezz, so unlike the bond. There are no cash payments, so in this case, all the interest payment is added to the principal once you exit or at the end of the life of the instrument, and the maturity of the instrument. It is very high yield. So the benefit, clearly the reason why you will go for that is because you don't want any other cash to go to the debt holders. You want to keep it in the business, reinvest in the business. But obviously the penalty you pay as a borrower is that you pay huge interest. Okay, so 15% is unheard of. By the way, 15% is also very often what the shareholder loan is charging. So remember the shareholder loan we talked about, which is part of the equity. So if I'm the fund manager and I'm going to be investing some of my money, instead of having ordinary shares or preference shares, I have a shareholder loan, I will often charge 15%. So this can be quite, it's every year, so the cumulative effect is pretty big. So right, this is really the benefit I told you about. You get breathing space. No matter what happens during the life, you won't have. That you can. Yeah, it gives you time to go through a recession, for example. Right, so if you're raising a PIK in 2007, but you don't have to pay any interest, any principal for, say, 10 years, you got a lot of things that can happen in 10 years. You're safe. Nobody can call the shots. Of course, you have financial covenants sometimes. We'll talk about the covenant-light deals, but very often, only the covenants will hurt you. But otherwise, you have nothing to pay for the life of the instrument. There's something called a toggle note. So the toggle note is simply you decide that you are going to defer interest payment, and in this case, so that that happens a lot for mezz. If you realize, I can't pay the cash interest on the mezzanine. So what you do is you create a PIK toggle, so you transfer that cash into PIK. Now you can do it for 1 year, or just one repayment, or you can do it for 2 years. But every time what happens is obviously it gets added. No, it's not a freebie. It gets added to the end of the maturity or simply whenever you exit the deal. So that's what the toggle is. It's simply a mechanism where you are allowed to transfer that cash payment into PIK. Clearly what happens then, again, no freebie, the lenders penalize you. They say, fine, okay, you don't want to pay me cash, fine, but that means you're going to pay higher rates at a later stage. So when you pay me back, instead of say if you're waiving 5% cash interest, I might tell you, okay, but the peak will be 6%. So it's a penalty again. Okay, so lots of flexibility here on the debt side. Everything is negotiable in life, except attendance. All right, financial covenants. So we talked about that. The key ratios are these here. So that means you can have total leverage ratio, that's your net debt on your EBITDA. Typically, we talk about EBITDA. It can be EBITDA, EBIT. Any reason why I might want to use different earnings? I'm assuming you know what EBITDA stands for. I know that all of you are in corporate finance or in accounting, but EBITDA is pretty common. So earnings before interest, tax, depreciation, amortization. Why would I want to use EBITDA and sometimes EBITDA and sometimes EBIT? So if I've got, here I've got total net debt to EBITDA, sometimes I could have EBITDA instead, without the D.
To make companies comparable on a capex basis.
Okay, so capex, you're probably talking here about the D. So my capex is what I spend on assets, and therefore if I spend on assets, that means I have to depreciate these assets. So in that case, if I have no capex, I might use my EBITDA instead, right? I don't need the EBITDA. Why would I want to EBIT here? Why would I use EBITDA instead of EBIT?
There are no intangibles in the business.
So here you have no intangibles. And no tangibles. Can you give me examples? Okay, so which industry would I want to use EBITDA for?
Any industry that is capital intensive, maybe an airline industry.
Okay, airlines. Anything else? Nothing else?
Manufacturers.
Okay, manufacturing, any heavy industries, steel manufacturers. Okay, EBITDA. D. Software. What else?
Pharma.
You have quite a few